I'll hand over to Priscilla for the opening remarks. Over to you, Priscilla.
Thank you so much, Vera, for that warm welcome. I thank all the participants that are present today. I would like to recognize in our presence our different panelists, Dr. Anthea Pawelo, Dr. Vela Kedogo Kigwiru, Mr. Raphael Mburu. Thank you so much for being on this training program. On behalf of Diamond Advocates and in partnership with the Fintech Service Providers Association, FITSPA, and Uganda Law Society, it is my pleasure to welcome you all to this training for competition law compliance for Fintech service providers. And today's theme, competition issues in digital financial services market towards effective compliance, could not be more timelier. Uganda's fintech sector now numbers over 200 fintech companies, and it continues to be one of the fastest growing digital markets on the continent. It has also reshaped financial inclusion, access to banking, payments, and credit. But that growth does not come without scrutiny, and competition authorities across the globe are increasingly paying close attention to how fintechs compete, partner, and use data. We've seen this play out with the European Commission's action against the MasterCard and Visa, and closer to home, we've seen the Competition Authority of Kenya investigating Safaricom's M-Pesa agent exclusivity agreements. Here in Uganda, we've had a case, Easy Money versus MTN. In 2024, we saw Uganda's Competition Act being enacted, and we are seeing live enforcement alongside ESC, COMESA, and AFCITA frameworks. So for the firms in this room and the participants and the members of FITSPA in particular, understanding this landscape is no longer optional, as it is part of managing business risk. And that is exactly why we are convening here today. We shall not be simply explaining the law, but we shall be equipping our participants with practical tools to identify competition risks, navigate mergers, partnerships, respond to investigations, build compliance programs that protect your business. And like I mentioned, we are privileged to have with us a distinguished panel of experts. I will read out their bios shortly. I want to also thank FITSPA and Uganda Law Society for their partnership in making this training possible. And thank you to each one of you for taking time out of your busy schedules to be here. I will start with, Dr. Vela Kedogo Kigwiru. Dr. Vela is a postdoctoral research fellow at the Chair for International Relations, Munich School of Politics and Public Policy at the Technical University of Munich. She holds a Bachelor of Laws and a Master of Laws from the University of Nairobi, a postgraduate diploma from the Kenyan School of Law, a PhD from the Technical University of Munich, Germany, awarded with distinction, high distinction, magna cum laude. She is a dynamic legal political science scholar, practitioner, and policymaker with over 10 years of experience in technology, competition, human rights, data protection, artificial intelligence, and consumer protection enforcement in Africa and the EU. Vela's work is informed by in-depth academic knowledge and empirical research. She has undertaken qualitative and quantitative research interviewing African competition agencies and legal practitioners on the enforcement of competition law at the national, regional, and AFCITA levels, which has culminated in 2 publications. Now I'll move to our other distinguished panelist, Dr. Anthea Pawelo. Dr. Anthea is an economist with a decade of experience in competition economics, economic regulation, gender and financial sector development across East and Southern Africa. She specializes in the intersection of competition policy, digital financial services, and women's financial inclusion, with a strong focus on how market structure, regulation, and platform dynamics shape outcomes for underserved and marginalized populations. Currently, she's a policy expert for competition and financial inclusion at the Alliance for Financial Inclusion, and she serves as the technical lead of the Competition Enablers Knowledge Exchange, supporting regulatory and supervisory frameworks. Previously, Dr. Anthea was the intervention manager for the business environment at FSD Uganda. I will move to our other panelist for today, Mr. Raphael Mburu from the Competition Authority of Kenya, where he has served for 11 years. He is currently the head of mergers and acquisitions. He possesses advanced skills in competition law and economics, dealing with the regulation of market structure. He holds a Master of Business Administration from the University of Cambria, postgraduate diplomas in EU competition law and economics for competition law from King's College London, and a Bachelor of Science degree from JKUAT. And last but not least, Dr. Ryan Hawthorne, who will be joining us later on. He's an economist working on competition and economic regulation. Ryan has provided expert economic evidence during litigation proceedings before competition authorities, economic regulators, and courts. He has also led economic analysis for a range of economic regulation projects, including on competition in digital markets and price regulation in the telecommunications and energy sector. He holds a PhD in economics from the University of Cape Town, a master's degree in economics from the University of Witwatersrand, and a BUCSC from the University of Cape Town. He has presented a number of papers at conferences and has several publications. So without taking on any more time, I would like to invite Mr. George Wilson Senkande from FITSPA. If he is on this call on behalf of FITSPA. Thank you so much. All right, so if George is not on this call, I'm suggesting that we start the training in the interest of time. And our first speaker for the day will be Dr. Vela Kedogo Kidwiru. Please, over to you, Doctor.
Just give me a minute. Can we all see my presentation?
Yes, we can, Doctor.
So you can hear me, right?
Yes, we can hear you right.
Yeah, thank you so much, Damo's advocate, for inviting me to undertake this training to the participants and stakeholders of the digital financial markets in Uganda and in Africa at large. And today I'll take the participants through the basics of competition law to enable them understand why we are having this session today. So for this particular session, I'll take you through the basic principles of competition law, the prohibited conduct under competition law in many jurisdictions, and then we'll have an overview of the Ugandan competition law, and then introduction to competition law in digital financial sector, because the other trainees will take you into the details of some of the competition issues in the digital financial sector. So the first question we need to ask ourselves is, what exactly is competition law? Oh, this is better now. So generally, competition law is a market regulatory tool that seeks to enhance rivalry within the markets to ensure that participants in the market compete against each other. And its goal is not merely to protect individual competitors, but to protect the competitive process of the market to ensure that consumers benefit from these markets. And some of the benefits that consumers benefit from competition is that they would have lower prices when it comes to products, and also they have access to quality products. But then the goals of competition law can be economic, they can also be non-economic goals. If you have a look at my latest publication on public interest consideration in African markets, you realize that the goals of competition law in developing countries, especially in Africa, go beyond consumer welfare and encompass issues relating to economic development, as well as ensuring the participation of small and medium-sized enterprises in the market. So there's a number of prohibited conduct under competition law. Most of the time, the prohibited conduct is it relates to restrictive trade agreements or abuse of dominant position, and also ensuring that the mergers, acquisition, joint ventures, or strategic partnerships are not uncompetitive. So to enable us understand most of the conduct that we are going to talk about as it relates to digital finance services market, I'll briefly explain some of the basics anti-competitive conduct that most organizations and competition agencies seek to address. So the most common one is price fixing. And price fixing occurs when undertakings or companies set the prices of product instead of market forces. So they agree among themselves either to raise, to lower, or stabilize prices of their goods so that they're able to control supply and demand. And someone will say like, oh, maybe this price fixing do benefit consumers? No, it usually benefits the firms that are involved in this kind of anti-competitive agreement. Another anti-competitive conduct that we are going to look at is market allocation and subdivision, whereby undertakings agree to allocate specific customers, products, or market among themselves. And the main goal of this kind of conduct is to exclude competitors from this market, creating artificial barriers into that specific market. Another important conduct that we're going to look at, and which also applies to the digital financial services market or digital markets generally, is predatory pricing. This kind of anti-competitive conduct is a pricing strategy where firms set prices below cost with the objective of excluding other firms from the market, not to ensure that consumers have lower prices to the specific product, but to exclude other participants from the markets because they are not able to offer their products at a lower cost, at lower prices below the cost. And once this happens, once the other participants leave the market, then the firm that engaged in this conduct raises the prices again in order to recoup the losses that it had incurred during that period. Bid rigging is also another very important malpractice in markets that we need to look at. And this is where competitors coordinate their bids, undermining the competitive bidding process. So most cases they will agree, will submit the winning bid in a specific contract, and in doing so, excluding other participants from these markets. Very important, and I think Anthea will talk about this in detail, is the concerted refusal to deal. In some cases, although in other countries, especially the US, the conduct of refusal to deal is not given as much attention as it is in European countries or in African countries. But refusal to deal ensures that market participants can allow competitors to access a specific infrastructure, especially if that infrastructure is indispensable or is difficult to replicate. So in cases where an undertaking or a firm refuses to allow other competitors to access their infrastructure, when that infrastructure is difficult to replicate, competition agencies might investigate this kind of conduct, unless there are justifiable reasons as to why that firm does not allow other competitors to access that infrastructure. For example, issues to do with security and privacy. It's a very common anti-competitive conduct in digital markets that my colleague will also look at. In other cases, exclusive dealing, which is identified in Article 9 and 10 of the Ugandan Digital Competition Act, is whereby you find some firms, especially in a vertical relationship, having exclusive dealing agreements that prevents other firms from using or reselling products to a competitive supplier. So in this case, you find that a firm is entering into an agreement requiring the other firm not to deal with other firms. Resale price maintenance also is an uncompetitive conduct whereby a supplier prevents a customer from selling a product below a minimum price. So in this case, they end up setting the prices of the specific product instead of the competitive process. I hope I'm as basic as I should be. Bundling, tying can also lead to anti-competitive effects, especially foreclosure. And this happens when a firm ties the purchase of another product on another product. And in competition law, it becomes a competition concern when those kind of products, that kind of tying lessens competition. And also when you look at those products, you may realize that it's not important for the consumer to buy those two products. They could literally have bought one product. So it turns out that when those products are tied together, either they're undermining the consumer's choice because maybe they don't need that product, but also because a firm is trying to ensure that a specific product enters into the market at the disadvantage of other firms. So all these examples of the anti-competitive conduct that I've mentioned, the specific legal tests or legal presumptions that have to be made for them to surface. So it's not that in all cases that we have such conduct, it leads to anti-competitive effects. So as a market participants, you also have to understand the legal tests for each of these anti-competitive conduct. For example, when it comes to like refusal to deal, you really have to show that the specific infrastructure was indispensable, it was difficult to replicate, and there was no objective justification of why that firm is prohibiting access or is blocking access to its competitors. And if you want to have a good look on one of the enforcement decisions in the digital markets, look at the recent decision from the EU Court of Justice in the Google Android Auto case. It's one of the most discussed cases in digital markets. So mergers and acquisitions, an aspect that Mr. Mburu is going to talk about in details, seeks to regulate acquisitions, joint ventures, strategic partnership to ensure that they do not create monopolies that would later abuse their dominant position, and also to ensure that it leads to a competitive process. So another aspect I wanted us to talk about, because most of the participants are coming from the Uganda FITSPA, is that there are also other specific conduct that are prohibited under competition law when you are a member of a trade association. And the reason why competition agencies in most jurisdictions always go for trade association is because trade association provide an avenue for members who are in a horizontal relationship, who are competing with each other in the sale of specific products and services to discuss issues relating to their market. And within those kind of discussion, they may engage in anti-competitive conduct whereby they discuss issues to do with prices, fees, discounts, margins, or charges. And you see, when we're talking about price fixing, you are not supposed to discuss and coordinate this kind of information. So under competition law, members of trade associations are prohibited from price fixing. They are prohibited from exchanging sensitive business information. For example, your strategy, your bid intention, your capacity, your customers. You are also prohibited from allocating markets among yourself, including indicating that if in Uganda, let's say, we are going to operate in Kampala while other people are going to operate in Jinja, that one is not allowed in competition law. And also during those meetings, you are prohibited from discussing issues relating to the bids and the tenders that you have, and also from entering into discussion that would lead to instances of refusals to deal. But then how can you ensure that during these discussions, you can say, I was not part of this discussion? So under competition law, what happens is that if there's a topic that is being discussed relating to prices or market allocation or sensitive information, you can always object, you can stop the discussion, and you can leave, but you also have to record in the minutes that you are not part of that discussion. So as Mr. Mburu will also tell you, is that most of the cartel investigation that the Competition Authority of Kenya has undertaken have been against trade associations. So it becomes very important when you meet after this, you understand that these are some of the anti-competitive conduct that you are not supposed to engage in. So when you are drafting your compliance program, these are some of the do's and the don'ts that you're supposed to include in those anti-competitive conduct. So an overview of the Ugandan Competition Act is that it has the provisions relating to restrictive trade agreements under Section 9. It also prohibits abuse of dominant position under Section 10 and it also prohibits anti-competitive mergers, and it has provision relating to when to file and when to notify these mergers with the technical committee under the Ministry of Trade. So far, I saw from Ad Legal that we've already have mergers that have now been notified to the Ministry of Trade. So we'll go into details later. And therefore, the question is then, why are we here today? Because I don't have much time. I don't want to get into Dr. Paelo's discussion. The reason we are here today and the reason why we are discussing the DFS market is because the African DFS market is growing tremendously. And it's supporting a lot of businesses. And the main essence of digital financial services was to enhance financial inclusion, because the banking sector was highly concentrated in most of the African countries, and many people did not have banking accounts as well. So fintech in itself came in as a tool to ensure that people are able to be part of these markets. And the mobile money market for Africa is the leading one in the world. And in Uganda, we have more than 200 fintech startups. And also, I know Anta is going to talk about it. Also, we have the big tech companies that have also entered into the specific markets. So it becomes extremely important because African governments are also relying on the digital financial service sector as a means for economic development, poverty alleviation, and so on. So today we are going to discuss the role of competition law, and we have key experts who are going to discuss this. And we are going to look at, we have discussed some of the key anti-competitive conduct, but then the digital markets brings with it novel anti-competitive conduct that were not anticipated maybe in the 1989 when the Sherman Act was developed, or when the European Union was developing competition law, or when African countries were adopting their competition laws in the 1990s. The digital markets, as Dr. Paelo will show us, has characteristics that make it difficult for even competition agencies to assess these markets. It makes it difficult for them to also even identify the relevant market definition because of the network effects, the importance of data in this market, and even issues relating to new anti-competitive conduct like self-preferencing, whereby some of the firms, because they provide the infrastructure on which this business operates and also provide goods and products that compete with competitors that are on those platforms, can do what we call self-preferencing. That is giving their products more advantage, more visibility through ranking and so on. So I will not go into detail on that slide. And also very important is that African competition agencies have not been left behind. They have increased their investigation into digital markets. And they're not just focusing on the big tech companies like Google or Uber or Bolt or so on. They're also looking at the local African tech companies. Therefore, as Uganda starts enforcement of its competition law, we are going to see it. We are going to see the technical committee looking and investigating in this market. And the question is, are you prepared? As a participant in this market, if you're a fintech startup, do you know some of the anti-competitive conduct? If you're given an agreement between you and a big tech company, are you able to identify the competition concerns and bring them to the attention of the competition agency, or just protect yourself as a company? So these are some of the important investigations and digital market inquiries that are happening on the African competition landscape. More importantly, in Uganda, it's not only the 2024 Competition Act that applies to the Ugandan markets. Uganda is a member of the East African competition, the East African community, as well as COMESA. It's also a member of the African Free Continental Free Trade Area, the FCFTA, and therefore, if you're operating in Uganda, it means that these regional and continental competition regimes will apply to you. And more importantly, if you look at the Ugandan Competition Act and you look at the 2025 competition regulation, they provide for instances when they will investigate digital markets. For example, under Section 9, Section 10, Section 13, especially Section 13 on exclusion of competitors, it identifies refusal to deal as an important anti-competitive conduct. And also in determining abuse of dominant position, the technical committee will take into consideration issues relating to network effects, data, access to infrastructure, and so on. Therefore, kindly pay attention to what Anta will be talking about, because all those provisions are under the 2025 Ugandan competition regulation. And very important, if you go to the Ad Legal website, there's a market study that we did on competition in digital markets, and you realize that the Ugandan digital market infrastructure is not only about the financial sector. We have so many sectors, including ride-hailing, food delivery, meaning that the Ugandan digital market is expanding rapidly. Look at the COMESA, the recent 2025 COMESA Competition and Consumer Protection Regulation. You realize that the COMESA Competition and Consumer Commission, as it has rebranded its name, will look at issues relating to gatekeeper regulation under Regulation 38, and therefore this means that the big tech companies operating in Africa and Uganda will fall under the jurisdiction of COMESA. And more importantly, it also regulates economic dependency as an anti-competitive conduct. And it also has provisions relating to digital mergers and provides for how it will assess specific mergers that meet specific transaction value. And also it has provisions on abuse of dominance. So all these developments at the COMESA level, it's something that you should look into. And the recent investigation by the COMESA, Competition and Consumer Commission, on Meta AI, whereby it's trying to investigate whether by Meta refusing to give access to other AI chatbots on the WhatsApp API leads to an abuse of dominant position. An investigation that the COMESA Competition Commission started because Ad Legal did file and request that the COMESA Competition Commission should do this. And therefore, this kind of developments on the African continent simply means that you must understand how this market operates, especially if you're a participant. And to just go back to the FCFTA competition protocol, I have a publication on this as well, is that Article 11 of the FCFTA competition protocol also seeks to regulate digital platforms and digital gatekeepers to ensure that they don't abuse their position of economic dependence. And it prohibits some of the anti-competitive conduct that Ryan will talk about, self-preferencing, combination of data, and steering provisions, which prohibits participants or competitors from steering their consumers to other either alternative payment infrastructures or alternative platforms for them to have access to the specific products or services. Therefore, it's very important that we have a deep understanding of Article 11 and how it also reflects global experiences, especially at the European level in the enforcement of its EU Digital Markets Act. I have 10 minutes to go. So because of this, there's also another important aspect that I think we need to look at, and which I think Anta will also talk into. Because of this increased attention into digital markets, and if you've been following the South African case, it has also undertaken a number of market inquiries into online intermediation platform markets. It has undertaken another market inquiry into the digital media market. The Competition Authority of Kenya has also undertaking market inquiry into online food delivery market as well. And therefore, it's very important, in addition to understanding what is the specific anti-competitive conduct that these competition agencies are looking at, and how you as a business, you as a policymaker or a lawyer or a legal advisor, you are able to provide advice, or you are able to also defend your client from the business side if an investigation starts in this market. And therefore, there is new theories of harm that are very different from the traditional market that we also look at. For example, we've talked about the self-preferencing, whereby certain platforms favor their own products. We have the tying, the defaults. For example, when we talk about tying and bundling, whereby you are required to, especially in a market where we have a digital ecosystem. A digital ecosystem is whereby a specific digital platform is providing different services and products that are integrated. For instance, Meta is providing Facebook, Instagram, WhatsApp, Threads, and so on and so on. So that's what we're talking about. So for you to be able, for example, in some of the cases that we've involved data, it would be like, for you to use Facebook, you have to allow Meta to access the data on WhatsApp. Those are some of the forms of timing bundling. And then the role of data, which Anta will talk about, and also the issue of remedies, how to open up these markets through interoperability, decisions, data portability, and so on. Data portability is all about allowing consumer users to share their data with other platforms so that they're able to also have a competitive advantage in this market. While interoperability is all about allowing devices, services to communicate with each other and to share data among themselves. For example, if you're in Kenya and you have a Safaricom line, you can use it to call somebody with Airtel because of this happens because of interoperability, so that you're able to use different services and platforms. So with that in mind, I still have 9 minutes. So with this in mind, I know according to the program, we should have at least a 10 minutes break, but I might choose some of the 5 minutes if you have any questions of clarification before now we get into the real training. Thank you so much.
Thank you very much, Dr. Vela, for your presentation. And I hope everyone on the call has an idea about competition, especially in the digital market. If there are no questions, we shall proceed to take a short break for 10 minutes, and we shall be back to continue the training. And Dr. Anthea is our next speaker. See you in 10.
Thank you.
Welcome back everyone from that short break. Once again, I'm Vera Karasita from Diamond Advocates, and we are going in for the second module that's going to be led by Dr. Anthea. She's a competition policy and financial inclusion expert. This second module is going to look at the digital financial services ecosystem, the network effects, interoperability, data standardization, payment infrastructure, and access to essential facilities. Dr. Anthea, the floor is yours. Thank you.
Thank you. Morning, everyone, or good afternoon, wherever you are. I'm going to start just briefly, if you don't mind indulging me, with a short Mentimeter quiz. I'm not sure if you can all see my screen. I hope you can. The instructions should be here, but it would be great to know who is in the room so that I can really tailor some of the discussions that I have to what you're looking for. So if you don't mind indulging me. As the coordinators have introduced, my name is Anthea Pailo, and I've been working on competition economics for the better part of a decade. And I've been particularly excited to be able to share or to have this training with fintechs in Uganda. I know it's particularly relevant for them. Given, yes, the novelty of the Competition Act and regulations, but also because these are very real concerns that they're experiencing in their day-to-day. So it would be great to know who is in the room, who is speaking to, so that I can really tailor that. And maybe just to add that as Ms. Vera stated, there's a lot that we can discuss about competition in DFS and as it applies to fintechs. But with this, it's a lot. We could not cover that in the 45 minutes or even up to the 1 p.m. time that we have today. So we'd want to tailor this to be very specific to what you'd be looking, what you'd want to answer. And that's, I think, is what I would want to answer for you, the questions that you're specifically looking at. So what I'll attempt to do in this short period of time is to provide a context of the market, of the challenges that I experienced. There might be some overlaps between my discussion and what Ryan does discuss later, but I'm still happy to do that because we have different experiences and there will be additional explanations that you get from, say, Ryan that you might not be able to get from myself. So yeah. Okay, so far, just going to mute. Yeah, okay. So far, what we have is we have one fintech company so far, one development partner. We have 4 law firms. I see we have a lot more participants, so I'm hoping that you continue to share. I have another question about what you want to take away from this training. But if you have already taken the Mentimeter details, you can continue to answer that on your phone while I get started with the presentation. So I'll just take another 30 seconds for you to maybe take the QR code or go to mentimeter.com and then put in this number 48516167. I'm hoping that you continue to share which institution you're from and what you actually want to take away. But also feel free to add that in the chat as well. So for now, what I'm seeing is that the larger representation is from law firms so far. So I'm just going to stop sharing this so that I can start sharing my slides. Okay. Okay, I'm going to get started now. So of course, navigating competition in digital financial services. But as I've mentioned, this topic is really quite wide. And it's often it's a bit difficult to narrow down what we want to discuss to these few hours that we'll be discussing today. Ideally, it would take a couple of days, and even then you'd need a bit more time to properly understand. But I want to thank Vela earlier for trying to provide at least some of the key meanings of the words that we use in competition. So as a background, why do we worry about competition issues in DFS? And you might already, if you're a fintech or if you're working in the fintech space as a lawyer, you might already understand some of these challenges as well. So digital platforms have been probably the largest contributor to the growth of digital financial services in the last 1 to 2 decades. Because of digital financial services, such as mobile money, and the providers that provide these services, fintech such as yourselves, these services have expanded and created substantial value. But the reason they have been able to scale has been because of largely network effects and scales of economies of scale. So these digital financial services and these providers exhibit what we call network effects. And please allow me to try and break down these as much as possible. I don't want to leave any of the attendees behind, and it's very much a training. But when we talk about network effects, we're talking about the fact that a provider or a platform provides more value the more providers that are present on the that are using that same platform. For instance, and I'm going to use Ugandan examples, if you're an MTN, if you're an Airtel, you're more likely to use one of those two providers because most of your comrades, most of your colleagues and family are using those platforms. This would be particularly more relevant maybe 5 years ago when we had a lot more competitors in the space. Right now, we basically have 2 telco providers in the market, but still you'd more likely to choose the provider who where most of your family is using because it's most likely to be cheaper, you'd get more promotions. And so these are markets where they have network effects. In other words, if a provider is the first into the market and the first to reach a certain mass of consumers, you reach a turning point or a tipping point where you naturally begin to attract more and more providers, and you grow and grow and grow rapidly, which can give you the scale to become a dominant player. And there's a specific legal definition for that, but really a player that has a lot of the consumers or a lot of market share. So yes, incumbent providers with fast mover advantages, they're the first provider into the market, can easily rise to dominance. And when we talk about dominant firms or dominant financial service providers, we refer to firms that are able or have the incentive to act anti-competitively. And let me break this down a little bit. We mean these are firms that, dominant firms are those which have a lot of market power. They have the ability to set prices independently of any discipline. So normally what would happen in a market is, say, if you're selling a car, or maybe that is, if you're selling toy cars, you're selling toy products, and you sell them, say, at 1,000 shillings. A neighbor comes and sees that, hey, your cars are going very fast. I'll come as a competitor and set up my toy shop right next to yours, and I'll sell mine at 800. And you'd be able to steal consumers, and they'll come up and take your products. What happens with dominant providers is, or in such markets, is that we find it's very difficult for another provider to enter into the market to sell a similar product to yours because of characteristics of the market. You might find that toy car that you're selling specifically is unique. It uses certain motor parts, or it's a battery operated in such a way that that your provider cannot easily acquire them. You need to import them from a particular place. The value chain is very difficult, so it's difficult for them to get competitors. If you're able to get competitors, they can enter into the market, they can set lower prices, and because they're able to set lower prices, they can steal consumers from you. If you're in a market which is in a digital platform or a digital market such as digital financial services, it's a little more difficult. Providers are not just looking for cheaper prices. They're looking for product through which they can easily communicate with other providers. It is also not very easy for another provider to enter into the market. Uganda is a typical example. We largely have two key providers here for telco services, voice and SMS. It's not that it is profitable if you look at their margins. So ideally, we would see other providers trying to enter into the market to provide your voice, SMS, and data services. But we find that they're not usually able to rise to the prominence of the two larger players, largely because you can't easily set up, for instance, the and I'm forgetting the term for the Mulongoti. I'm forgetting the English term, but you're not typically able to get to set up the networks that you're able to provide the services. If you're looking at mobile money, you're not able to set up the agent networks quite as easily. You're not able to provide the SIM cards. It's a whole different ballgame in terms of a new provider. So this makes these digital platforms a unique kind of market. Moreover, these are platforms that are able to collect critical masses of rich data. And we're in an economy where data makes a large difference in terms of the types of services you provide, the quality of services you provide, how tailored they are to a market. And so if certain providers have amassed large amounts of data over time, it's very difficult for a new provider who may require that access or that amount of data in order to provide the services at the same level in order to win customers. So in others, economies of scale and scope fuel positive feedbacks, strengthening fast mover players or incumbent players' positions in the market. So when we look at financial services, just to give, and this is still part of the background, we understand that the market has evolved past from traditional branches where we had physical branches, limited data. It was high structural costs. You have to set up an expensive ATM. But because of mobile money, and I'm speaking about local examples, there's been such a revolution in the market, and we're no longer depending on these old or traditional ways of using financial services or accessing financial services. We now use more modern means, initially USSD, which is your star 100 over a feature phone, but increasingly using data to access financial services. Banks are also able to provide financial services through mobile banking on a phone. And now increasingly we're seeing growth into digital and neobanks where they're completely not using any of the physical infrastructure that we typically used before. And these are expanding more. We're seeing banks that originally began probably as e-commerce platforms and are expanding into other areas of financial services, or others that started from payment services themselves and now are increasingly extending into other digital markets. For instance, we see MTN now has a digital market that it's encouraging. Safaricom did the same in Kenya, and you see this in other markets where they're trying to create super apps and bringing in lots of services, such that they're expanding the segments that they're able to operate in. So this is basically what I've been talking about. Digital platforms have scaled across sub-Saharan Africa and Asia. They've brought millions into the formal ecosystem, but this has tipped in the favor of fast movers, creating kind of these large players that have substantial market power. So there has been, of course, the benefits to, excuse me, the benefits in terms of lower prices for consumers, improved user experience. We're seeing, excuse me, merchants, SMEs that are we're having improved access to them. On the merchant side, they're better able to access their customers, they're better able to run their businesses. On the competitive side, and where regulators start to get concerned, is where network effects trigger this kind of tipping of natural platforms, creating virtual monopolies or even virtual duopolies, just strong players. And maybe what is critical to mention here is that we don't have a problem. There's nothing wrong with being a dominant platform or a dominant provider in the market. And this is to encourage fintechs who want to grow, to continue expanding. The risk we fear with when platforms are really large is that they have the ability often to act anti-competitively. They may have, for instance, access to strategic or to certain key platforms that they might refuse to provide access to. They may engage in certain conduct that will force other players out of the market, or they may have the ability to raise prices beyond the value that they provide, such that consumers do not benefit. So they can also refuse, for instance, to interoperate. If you have only 1 or 2 players in the market, and you as a fintech, for instance, have a new health service, you want to provide health financial service, the only way to access your customers is through a mobile money rail or through a bank or a neo bank that might be existing. You need access to that bank. Should that bank or should that provider refuse to give you access to their customers, you're basically locked out of the economy and you cannot provide even this unique service. For consumers, that's a loss because I might be looking for a health financial service that you as a fintech are able to provide. But if I'm not able to access it on my mobile phone, then that is a challenge for me. There are also instances where a provider might allow you access, but may charge you expensively to gain that access, that as a fintech, you're not able to enjoy these services. You're not able to enjoy the benefit of your innovation, the benefit of your innovation, the benefit of your own investment into the product. So we have seen instances such as that. The more common examples are things such as USSD and SMS, where we have seen in certain countries, especially within East Africa and even out of East Africa, where MNOs being mobile network operators, have been accused of charging high costs for access to USSD. So what are the key barriers to competition that we often encounter, often see in the market? We put them into 3 key categories. Ordinarily, competition should be demand and supply. If there is demand for a product, providers increase in order to meet that demand. If there's a lot of supply, demand meets, consumers rise up and they are able to purchase the products that are available. So that should be the case. But then there's certain markets where there are structural barriers. I've talked about network effects. The other thing that I've not really spoken about is heavy sunk capital costs. There are certain markets where it is extremely expensive to enter and operate into the market. You have to get a license from the regulator, and there may be 1 or more licenses that you require. In the DFS market in Uganda, for instance, you may need a license from the Communications Authority. You may also need a license from the central bank. You may need, that is on one end. If you're trying to reach your consumer, you may also need agents. You may need access to agents. Agents require a commission. You may need to recruit them. You may need to train them. That is a lot of costs. And even being able to convert them beyond current agents to active agents is an additional cost. So that you have to plan into. Then, of course, there are high customer switching frictions. I have been an MTN customer basically since I bought a SIM card. I have not moved. A lot of people have 2 SIM cards. I have not yet had 2 SIM cards. I have had a 1 SIM card. And here we have a limited choice. But for instance, if you go even to Tanzania, which has about 5 mobile providers, mobile voice providers, and mobile money providers, you'll find there are a lot of providers who may have 2 or 3, but they will have 1 largely default provider, and they're not likely to change. The story is even more drastic, I think, when it comes to banks. I've also had 1 bank account. Okay, now last year I added a 2nd bank account, but you're typically loyal to the service provider that you get initially, which makes it very difficult for you to move. You already know how they operate. You already know the costs that are associated with it. And also it's just very difficult. How do you look through different banks to see which one is more suited to you? How do I choose a fintech? Why would I choose a neobank over my other bank, even if the service might be new, might be interesting. I would just be reluctant. I don't know. I don't want to find out. The information is too difficult. So that makes it very difficult for providers, for active competition to happen into the market, and for an opportunity to arise that will have strong dominant players in the market. Yes, then that's strong default behavioral brand trust, basically. So the market has network effects, they're heavy sunk costs. It's very difficult for customers to switch. Then the other category of barriers to finance, that they can be also strategic conduct that prevents competition. Because we find that in certain markets, there are dominant providers in the market. You find that, as I mentioned, there may be in order to access your customers, you may need access to USSD. USSD is maybe in Uganda is provided by largely 2 providers in the market. In other markets, there are more number of providers, but then even they have different levels of market share. So there are instances where providers deliberately refuse to give you access. One of the coordinators, Priscilla mentioned earlier, there was a case in Uganda, High Court case of MTN Uganda and Easy Money in court. At that time, we didn't have a Competition Act. The more famous one, or the more, at least the better documented one, happened in Kenya with Safaricom, where it wasn't actually a case, but it was an intervention and a discussion where the Safaricom had a discussion, a conversation with the Competition Authority, and the cost of access for the USSD was reduced from about 10 Kenya shillings to 1 Kenya shilling. This can make a difference for a fintech who is new in the market, who might just have an innovative product, but does not have the resources. The difference between 10 Kenya shillings and 1 Kenya shilling can mean the difference between making it even or getting losses, absolute losses. We have also seen instances of agent network exclusivity. In many markets now, agent exclusivity has been banned by regulations. In Uganda, it initially started with a mandate in the mobile money guidelines, where agent exclusivity was banned. But we've also had instances, and in several countries, even outside Uganda, where tacitly, where there will be conversations behind the scenes, and agents do not allow to provide certain services. So there can be strategic conduct where, whether it's access to USSD, whether it's agent networks, whether it is the switch, whether it is in terms of costs of off-net, meaning that transferring money from one provider off to another provider, where the costs are prohibitory, they're extremely high. And then another area that is continually starting to rise is now proprietary data, as mentioned. It is now becoming one of those key bottlenecks. In order to provide good services, in order to provide, particularly for credit, you need access to data about the consumer. There are certain reasons for this that make economic and even regulatory sense. You need to be able to protect the data, private data of consumers. But there are also instances where it is being used as a means to exclude players and exclude players from the market and exclude them from being able to actively provide services. There are, of course, also regulatory barriers, where there could be high licensing fees, rigid KYC requirements, and even lack of direct payment switch membership for non-banks. We have been seeing this in different economies, basically. So in terms of the market and the key actors, I've talked about these a little bit. MNOs, that are the network providers, there are also banks. And I mention these because they each have their own different areas in which they handle, or specific market segments that other actors may need access to. So whether it's banks, whether it's the agents, they have a specific role, whether it's third-party providers or aggregators, most of these is where the fintechs would likely fall into. They provide usually the back end and sometimes even the front end kind of services, whether it's in the user experience, the infrastructure, and other value-added services. Then, of course, the regulators. So at different areas, depending on the friction or the ability to collaborate or to access services from each of these players, this can create a bottleneck or can cause ineffective competition in different areas. So of course, the markets have been evolving rapidly over time, and these may not still be the same actors in the space. If you want to add a few more for us to discuss or new players in the market, please add them as well in the comments. So I introduced this to briefly say, and this is from a recent publication from AFI on advancing fair competition for inclusive digital financial services. You can access the material from there. But just to say that there are different points at which there's an opportunity for dominant providers in the market to either squeeze or create to strategically exclude other players from the market. It can be in terms of connectivity to access to certain services. It can be at the level of the distribution channel. It could be at the level of onboarding, and in terms of the different products and services, whether it's savings, loans, payments. This is kind of the ecosystem of services that are available, the DFS market, and the different points at which fintechs might require access and may struggle to access that, whether it's access to bank accounts, access to data, access to payment and settlement infrastructure, again, access to data, whether it's insurance market, whether it's in the payments market, loans, or even savings. So markets in which there might be dominance, of course, in the mobile market in terms of devices. This one may not be as applicable to us. It is on the global scale, but maybe not very relevant for this current discussion at the moment. In terms of agents and distributors, in terms of existing banks, in terms of the merchants that we're able to access, even in terms of the super merchants. There have been instances in terms of access for providing for USSD and SMS, data, as I mentioned, and even access to an app store exclusivity there. Then again, also, of course, access to national databases, data porting, and licenses. Again, this just to simplify kind of what we've been discussing at the connectivity level, distribution, onboarding, and transaction. There are different critical points at which a competition can be throttled and which may require either intervention from the regulator, and where fintechs may want to escalate this issue to raise this complaint where they're finding challenges, either accessing or whether the cost is so high as to be prohibitory. So certain just common examples, and I've just used two here for banking and also for USSD in terms of some of the common examples that we've seen. And the USSD in terms of access, we've mentioned this, but in East and Western Africa, we have seen certain challenges and certain cases brought because of access to USSD, where banks have been refused access, at an equitable or at an affordable rate to USSD. We have also seen instances where non-banks have been refused access to a payment switch in order to settle their transactions. There have been complaints in Tanzania. There have been complaints in Kenya, where MNOs have been seen to be charging sometimes up to 5 times higher for rates of access for USSD. Similarly, we have seen similar cases in Zimbabwe. So in a lot of markets, the more common cases in the banking sector have been in terms of cards and interchange rates. The more common examples we've had of Visa and MasterCard, and all around globally, we've seen lots of scrutiny and lots of cases, and many of them have found that there might be certain level of anti-competitive conduct in terms of access or closing out, or even high rates of interchange for whether it is the merchants or whether the banks that subscribe to these to the interchange fees that are involved here. So I have tried to kind of squeeze a lot of information in the short time that we had. But I wanted to, I don't know if we have a chance to have a discussion. I really cannot see the screen and the answers, but I wanted to give a scenario here and maybe just get your inputs on what your thoughts on this based on this discussion and based on your own experience. So if we have a fintech, maybe a microcredit lending app that is launching, okay, this is very common. A lot of us have these apps on the phones, but the dominant MNO-backed mobile wallet kind of blocks your instant payment APIs, or they refuse to give you access, whether it's to their USSD menus or to their instant payment APIs. What would you call this? Would this be a structural, would this be strategic, or would this be a regulatory barrier? I'm going to end the slideshow so that I can see if there have been any responses, or if anyone would even want to raise their hand to kind of to explain this a bit. But yeah, if you're a fintech microcredit lending provider, you're trying to launch, and there's you know that you want to access a dominant provider's whether it's their instant API or their USSD, and you are blocked from that, what would you call that? Would that be strategic, a barrier? Would that be a regulatory barrier? Would that be a structural barrier? Okay, I'm not getting any responses here. I'm hoping.
I think there's one.
Okay. Or you have particular questions?
Question.
Okay, it's a particular question. Which maybe somehow I'll give you the chance to ask those questions to actually speak. I don't know if we have that ability to do that. Okay, if we don't really have a response to that, I am going to pause here and just then give us time to ask questions and kind of get your own view and get what you might be interested in. Coordinator, can we allow Samuel maybe to ask his question out loud? Is that okay?
Yes, I'll inform Drake. Drake, please unmute Mr. Samuel Okorimo.
Okay. Let me, sure. Let me just respond to it. So Samuel, you've asked a very good question. Thank you for asking me that. So you're asking, yes, it's a liberal economy, and what purpose does competition law and framework serve in a liberal economy, and market, in which market dynamics play a key role in the success or failure? You're trying to say, and I think my translation of this, because a number of people have asked me this before, is that shouldn't we allow the market? It's a free market. Why should we be intervening? Now, what is specific about digital markets and digital financial service markets is that ordinarily, yes, demand and supply should be able to demand prices, should be able to determine prices, should be able to enable competition. But because these markets have network effects and scales of economy, free competition is not actually possible. There is a market failure, as you've put it. Demand and supply are not able to do what it's supposed to do, largely because if you are a fast mover into the market, if you have a lot of resources and you're the fast mover into the market, you're able to gain market share and maintain that market share for a long time. I have the graph here that I wanted to keep for just in case there were certain questions about. This is an old And this is a bit dated, but I thought it can give a good example of this. This is of the Kenyan mobile money market, mobile money transfer market. Between 2011 and 2019, you can see this is market share data. In other words, number of subscribers per mobile money operator. You'll see that over time, there's basically one operator was able to maintain substantial market share over a long period of time. Now, it could be that that one provider is very innovative, is very resourceful, and is providing the needed products and services for the market. But also, it is just incredibly difficult in this market for a new provider to enter into the market. You might be a new provider that enters into the market. We see, for instance, there were other competitors, Airtel market, Equitel market. You might come in with a unique product, but you're unable to access the same, you might be unable to access customers. A customer is not going to try a new service, is not easily going to try a new service, even if you might be cheaper, if most of their providers are already on one service already on one network. So there are certain characteristics of the market that make it difficult for the forces of demand and supply to work appropriately. There's a market failure. In such markets, that is where competition law, and that's where the regulator comes in to ensure that it is competitive and to level the playing field. They would level the playing field, for instance, by mandating interoperability, where they say that you must allow another provider to transfer money from one market into the other. Let me go to the next question because of time. What are the thresholds? To what extent should competition law apply? And on the other hand, what market dynamics determine what should happen? It seems to me that aspects of anti-competitive conduct is what is very often seen in the market. So is there serious compliance in competition law? So from my experience, and I'll also tap into Ryan if you can ask him this question as well when he comes in. But there are certain markets that seem to particularly lend to certain challenges in competition markets. So you'll see such digital markets, for instance. We have seen lots of cases, Google, Apple, Alibaba is being Facebook. There have been lots of cases. Digital markets is particularly prone to such because it gives rise to monopoly or players with at least substantial market share. So that causes that can create challenges into the market, and where it causes the regulator to have a more careful eye, because such players, what we've seen is that they do have an incentive to act anti-competitively. They do have an incentive to also raise prices. And we have certain material for this. If we had a longer training, I could probably go into a specific case study which shows you abuse of dominance in certain markets, how this often occurs. So there are certain markets in which this can happen, and which we should be looking at quite seriously. So there can be a compliance issue, and there is a compliance issue in these markets. I'm going to speak specifically for DFS because a lot of fintech sometimes fear they require access to key inputs. So they might even fear to go to a regulator, because if I go to a regulator, supposing there's retaliation, supposing the provider I'm reporting to the market, and I'm not referring even to the two bigger ones. It might be a bank, it might be some of the aggregators that have grown large. But if they refuse me access, and what happens then? If the regulator fails to resolve this issue, then I am left with a possible retaliation. So we find there can be certain compliance issues here. Yeah, and sometimes it's just that difficult because these markets are sensitive. So yeah, I'll pause there. And hope that I have answered your question. Coordinator, do I have can I answer Joel's question quickly? I know we've run out of time.
Yes, you can, Doctor.
Okay, does infrastructure sharing between dominant competitors get treated differently under Uganda's competition law regime? And where would mobile money access fall? Case in point, MTN and Airtel infrastructure sharing agreements signed last year. And this I would want to get the lawyers involved in. And then I would also want to know about, I've not come across this sharing agreement. A lot of information changes. So Joel, if you could share that with me later, that would be fantastic. But infrastructure sharing is one of those core principles that we talk about in competition economics, because we see it as a method or a tool to level the playing field, particularly in markets such as this where it is highly concentrated. Of course, the dynamics change if they are extremely concentrated, for instance, a duopoly, and also if it depends on the dynamics of the market. We have to do a proper market infrastructure, a market structure study to understand who the key players are and which markets we're looking at. So infrastructure, which particular infrastructure are we looking at? Are we thinking just of USSD? Are we thinking of the, and again, I'm forgetting the towers. Are we thinking about the towers? That also it determines which regulator comes into play. But yes, we generally look at infrastructure as a means to, infrastructure sharing as a means to level the playing field. The dynamics do change if it's only two players that are in the infrastructure agreement, because ideally you would want more providers to have access to the infrastructure, because that's what makes it competitive. We want more than two players to have access to the infrastructure, such that there is additional choice, the additional products and services that are provided. But I'd want to look at the infrastructure sharing agreement that you're referring to, and also look at the different way what the regulator was weighing. If they're only we're looking at reducing prices, and mobile money strictly is provided by largely two players, and the infrastructure agreement results in substantially lower prices for the consumers, that would be something that the regulators would consider as well. So I am going to stop there. Because I've run out of time, but maybe just in conclusion, this topic is very large, and I know I have touched a lot of things everywhere, but this is something that would want to have a longer session on, maybe and maybe touch on different topics. But there is material, however, that we can share, resources, which I think we'll be able to share even after the training that you can refer to. Thank you.
And I think you still have 10 minutes if you wanted to add something.
Okay, I was rushing. I thought 9:45 in my head.
We started a bit early.
Okay. I wouldn't want to go into, unless there are specific questions. Yeah, the rest would require a really deeper dive. So allow me to...
Maybe I have a question for you from your experience on researching on digital financial markets in Uganda. How can you describe the market? Could you say, or how can you describe it, or how can you evaluate it in future? Will competition law be a tool that will enhance competition in the Ugandan markets? Will it make any value? And how? The current Competition Act. You are muted.
Thank you for that. That's a very good question. And it requires a study on its own. First of all, the Ugandan market is very diverse. We would have to look at the different market segments. But maybe if I can focus on payments, transfer, P2P, and I say that because mobile money transfer is really what has been the gateway into financial services in Uganda. I will say that the market is concentrated. By concentrated, we have a small number of players with large market share. Typically, these markets don't grow very big because of the capital costs that are involved. But so in terms of mobile P2P itself, that is concentrated. But we can also extend that to a lot of the other related market segments as well. If we look at now savings, if we look at the lending that is available, for instance, on a mobile app, but we'd want to look at the different market segments and grow and expand on that. I had done a study of this, but I've been hesitant to focus on that because it is a bit dated and a lot of things have changed. But I will say, yes, even in terms of the third-party aggregators, there are certain levels of concentration. Again, concentration is not, it can be a sign of a challenge, but what we're looking at, we're looking for active. It may not be anti-competitive. We may not see any anti-competitive conduct. So we'd want to see if there have been instances where certain providers have been refused access or have been charged excessively. Informally, there have been certain cases. I know about a year or two ago, there was a case, a competition issue that was raised with the Communications Authority in terms of access to towers. And this is related again to the DFS market. We have seen instances where there was the easy money case that has been referred to. We are also seeing that the regulator, the Bank of Uganda, is trying to actively intervene. They feel like the market should be more competitive. So they have been trying to put in place a switch, which should ideally make it easier for non-bank providers and bank providers to have access to each other to improve the interoperability and lower the costs. Because I think one of the key issues in the market has been the high cost of transactions, and the common root cause has been explained that it's just expensive. Off-net transfer, sending money out of the network is extremely expensive for the providers. So, and what we've seen in the literature is that it could actually be expensive, but at the same time, it is very much sometimes used as a route or as a tool to exclude other players. So by bringing in an infrastructure such as a switch, that kind of levels the playing field. So there is, that is what the market would be, but I would very much want to do an actual present day study looking at the different markets and market segments and being able to examine that, because a lot has changed since I last did the study.
Thank you so much. Back to Diamond's advocates.
Thank you very much, Dr. Anta. That has been a good overview of competition in the digital finance ecosystem and market. It has been quite enlightening, and I hope our listeners have been taking notes. Thank you very much. So we are going to go in for another 10-minute break, and we shall come back and listen to Dr. Ryan. Welcome back from that short break, and you're now going in for the third module. It's going to be handled by Dr. Ryan Hawthorne, an economist at Acacia Economics. He's going to take us through the specific competition concerns in digital financial services, that is self-referencing, refusal to deal, and data hoarding, drawing on enforcement decisions from Europe and from Kenya's Fintech investigation. You're welcome, Doctor.
Good morning, everybody. I am not sure if we're ready to start just yet, but I'm ready when you are.
We are ready to start, Doctor. You're muted.
Sorry about that. Thanks for joining today's session. I'm Ryan Hawthorne. I'm an economist at Acacia Economics. We work on we provide economic expertise mainly for litigation. So we do a lot of work on on disputes that go before competition authorities or that go to the courts, and we provide expert economic evidence for those processes. We've worked in Uganda. My colleague Shaista Goga led a data services market inquiry or broader telecommunications market inquiry in Uganda, I think last year. And so I've been to Uganda, and I'm familiar with the environment. I've seen the gorillas, in fact. I went to Burundi. And so, yes, I'm somewhat familiar. Anthea has briefed me a little bit more about the details of the fintech market in Uganda. And so I'm very pleased to be debating these issues with you today. I really hope that the session will be as interactive as possible. We actually have from the Gates Foundation over the next few years to study competition enablers and accelerants in markets for services in a whole variety of countries, but including Uganda. And so I'm very interested in hearing your perspectives today, and I'm very curious to see what questions will be asked. And so please feel free to interrupt me at any point. I'd be very happy to answer your questions. The only issue is, though, if the only issue might be that I can't see the questions at the same time as doing the presentation, but hopefully somebody will prompt me. Actually, I've got the Q&A screen open now, so I should be able to see it. Okay, great. So please ask questions anytime. I'd be very happy to talk to you about this. So what we've done is we've studied what competitive markets look like in a whole range of different countries. And one of the first that I'd like to draw your attention to, and really if you're interested in understanding what a competitive market for digital financial services looks like, please start with Brazil. So Brazil has this very, very rich ecosystem of different sizes of licensees. They're obviously very large banks, as is the case in any other market. But what Brazil did, starting in around 2013, is they started to open things up dramatically. So after the financial crisis, as I understand it, in Brazil, there was a big political backlash against the very large sort of oligopolistic structure of banks in Brazil. There was a very strange payment system set up, in which, in fact, there were there were exclusive deals between, I think, Visa and one or a few banks, and in turn MasterCard and one or a few banks. And it was a very strange, tightly closed market. And what they did was they started to dramatically open things up in Brazil from around 2013. And what they did was they said, well, actually, initially, if you had less than 500,000 customers, you don't pose a systemic risk to the system. So actually, we're going to dramatically lower barriers to entry. Now, as economists, we're very, very interested in barriers to entry, particularly regulatory barriers to entry. And of course, what central bankers are concerned about is risk. In general, and they'd like to make sure that consumers are protected, that there aren't runs on deposits, depositors don't lose their money, etc. And what the Brazilian experience actually shows is quite the opposite. If there's an ecosystem of smaller entrants, they don't pose a systemic risk to the economy. And what they do is they dramatically expand access to financial services by competing with one another and therefore by exploiting many niches. Now, I understand that in Uganda things are opening up. I'm not sure if anybody wants to comment on this or ask a question about it, but I understand that there are around 30, Anthea was mentioning that there are about 30 fintech payment services provider. Um, and so things are opening up, and which is fantastic. That's what we'd like to see. And as you can see, you've got a very rich ecosystem on this particular slide. So in the top left, you've got the really big banks. And by the way, the big banks are still fine. They're growing strongly, and they're doing very well. And this is one of the big insights from a lot of the research on competition in financial services. What tends to happen is that the incumbents look a bit scared, right? They see all these 30 payment service providers in Uganda and they kind of think, gosh, this is going to be a big problem for us. But actually what tends to happen is they kind of tend to grow the market, and they grow the market together. And I think that's quite an interesting outcome from a lot of these competition studies. So they have different sizes. They've got the big incumbents, then they've got newer entrants, and there's one in particular that you should pay a bit of attention to, and that's Nubank. So it's a smaller it was a smaller entrant certainly back in 2013, and they've expanded dramatically in the market in Brazil, and that's the case with several other banks as well. I'll show you more evidence of that in just a moment. And so the idea is that you have these various different tiers of licensees, all of which are exploiting different niches and that are regulated on a risk basis. So there isn't some one size fits all structure and you need like $1 billion to set up a bank in Brazil. It's the opposite. So there are different sizes, different tiers, different activities, and these financial services providers are all regulated on the basis of the risks that they pose to consumers and to the broader system. So what is the impact of all of this been? Well, the impact, so this is the World Bank Findex, right? Which is publicly available. You can see the link there. And what you see is massively expanding financial inclusion in Brazil as the markets have opened up. So in around 2014, so in other words, just prior to, well, or just right at the beginning when the market was opening up, you had about 68% of people in Brazil, adults in Brazil, that had access to an account. And this expanded dramatically to 86%, right, over the subsequent few years as competition intensified. And so this has a dramatic, and of course we know that financial inclusion has important links to economic development. So it's not just the fact that we don't just care about competition for competition's sake, although I think there are very good reasons to open up your economy and have as many rivals as possible in all various different kinds of sectors of your economy, just from a pure human rights and economic participation perspective. Everybody should be entitled to build and grow a business. And the same applies in financial services. But even if you don't believe in all that kind of thing and you're worried about the risks and so on, the fact is that there's a direct link between expanded competition and expanded financial inclusion. And not only that, but expanded financial inclusion leads to greater economic development. There are also several other benefits which I'll go through in just a moment in opening up markets for digital financial services. Okay, so in case you think, well, Brazil's a bit weird, it's different in South America, they don't really have mobile money. What's that got to do with Africa? There are very similar approaches in other African countries, including, by the way, in Ghana. Ghana's also got this it's got quite a fairly open licensing framework. So they've got different kinds of payment service providers and digital credit providers and specialized deposit taking institutions. And again, this enables that they've created quite an enabling framework for promoting rivalry in markets for digital financial services. So setting up this ex-ante framework is extremely important for central banks, and it's you don't get past go if you can't even talk about opening up dominant platforms and interoperability and all of the other things that Anthea was speaking about if you don't allow entrance in the first place. Now, it sounds like Uganda is reforming quite a bit in this space by allowing 30 payment service providers. How many, I'm not sure if there are people in the chat that can comment, but I mean, how many people in the chat have entered in the past few years? How many people in the chat fall into this category of 30 payment service providers? Okay, I can see the chat. PSO licensed. Sorry, Anthea's correcting me. Thanks very much, Anthea. So yeah, I'd be very curious to see how many folks out there on the call this morning are actually payment service providers. And again, what we see in Ghana is very good financial inclusion outcomes. So we see these expanded access to account ownership since 2014, growing from about 41% to doubling, okay, over that period. Now, that's also to do with mobile money, okay, so that's not just purely Ghana opened up and then financial inclusion expanded, and that's the case with a lot of the countries. So when we're looking at evidence on outcomes in our various countries, it's quite difficult to disentangle sometimes what was related to opening up and expanding competition and what was and other factors, just such as the introduction of mobile money in Ghana. Okay, but we'll try and unpack this a little bit more. So, as I explained, there's very good evidence on links between competition and financial inclusion. So, promoting competition and financial inclusion. So, new banks and digital players obviously challenge the status quo. Okay, so the obvious example, including in Uganda, of course, is mobile money operators just challenging the status quo, showing how there are many millions of consumers who really have a very strong demand for financial services and that have needs that need to be addressed. And what happens is, so more competition. So there's a paper by Mengistu and Perez Sayers as on higher adoption of bank accounts. How more competition leads to higher adoption of bank accounts. There's a paper by Oriol, Gonzalez, and Fanfalone, how the entries of mobile operators results in traditional banks lowering prices and expanding physical branch networks. Is a wonderful paper on Kenya, in fact, exactly on this, on how actually as agents open up as mobile money agents open up in a specific geographic area, so it's followed by a bank branch, and I think in that case they used Equity Bank branches. Digital entrants, of course, lower the unit costs of transactions, which means that more and more people can afford these services, and a lower learner index. Learner index is just an index of markups, essentially price minus cost over price, and that leads in access to finance for firms. So it's not just that more and more poor people are picking up digital financial services, it's that more and more small businesses are able to access finance as well. So we get lower prices from more competition, greater financial inclusion, but it's not just lower prices, it's the fact that, as I mentioned, there's this wonderful paper on Kenya as to when agents open up in an area, then what actually happens is a bank branch comes in as well. And of course, what that means is that consumers can now actually access the financial service, right? So, beforehand, they would have had to get into like a matatu or onto a boda boda, travel kilometers and kilometers to a bank branch to hopefully get access to a service. As these services come closer and closer and closer to where consumers actually are, so they can actually use them. So lower distances, lower prices. These are very important issues. They're also very, very important and interesting gender considerations. So actually what happens is as greater competition is introduced, so firms, so financial services providers, including banks, expand into different customer categories and focus on different customer categories, including gender, including women. So there's a famous idea. I mean, slowly this is disappearing over time, but there's this idea that there's a banker bias against women, right? So women aren't creditworthy, maybe they're not the main income earner in the household, some or other prejudice, right? And so the bankers have these prejudices, and so women tend to get excluded. And there's a very interesting paper on US banking deregulation, for instance, between 1975 and 1979 and 1995. And actually the deregulation resulted in an increase in competition. And the wage gap actually closed for women, and the participation gap closed for women as well. Now, of course, over that time period, attitudes changed, other things were changing as well. But there is certainly evidence that greater competition reduces that gender gap. Also, simply product variety has an impact. So these researchers, Oluwache and Al Hassan, in 2025, found that the gender gap is quite wide in formal services, but it actually disappears in semi-formal services. So actually, in semi-formal services, you've got much more heterogeneity in the kinds of contracts that are being offered, and so women feel more included and are top and get access to more product markets. To products such as credit. Whereas in formal services, there tends to be dominant firms and very low and lots of homogeneity. All the contracts are very similar. There isn't much niche targeting of credit products, including to women. And so allowing more heterogeneity, in other words, allowing many more different kinds of fintech providers into the markets, reduces that gender gap. And then similarly, in America, there was a large amount of discrimination discovered by Atkins, Cook, and Seaman. So Black-owned businesses in America, they received 50% lower value loans than white-owned businesses. But as you had fintechs entering, then this gap starts to narrow. So as you start to allow more fintechs into the market, so you reduce discrimination, because they're very keen to attract as many customers as possible. So the idea is that you have more products, lower prices, and less discrimination, including against women, when you start to open markets up to greater competition. Okay. So let's start to have a look now, and there is going to be a quiz, folks. I know you thought this was a straightforward kind of one-way training session, but there is going to be a quiz. So please do pay attention to this particular slide, and that is on competition enablers and accelerants. So these are the series of factors that we think are quite important when it comes to promoting competition in markets for digital financial services. So first of all, as I said, you need the actual regulation, the regulatory framework to accommodate different business models. You need a Ghana setup or a Brazil setup where anybody can come along and find a license or find an authorization, or or not be blocked, frankly, by regulations to stop a business model. So this is very important. You need regulations accommodating different business models. You also need inclusive, interoperable credit infrastructure. Now, I did not ask this very important question of Anthea. I'm not sure if anybody on the call can comment on Uganda. Are there a lot of are there credit reference bureaus in Uganda that are interoperable, that allow smaller fintechs and so on to be able to participate in the credit system? If anybody can comment on that in the chat, I'd be grateful. And then the next step, and this I understand is being explored actively in Uganda at the moment, and that is inclusive interoperable payments infrastructure. And by that I mean exactly what Anthea was speaking about earlier, which is an instant payment switch. It's very important. So it's one thing to say, well, we've got some spaghetti connections, Airtel connects with MTN in Uganda, you can send payments across networks, that's all very well. You can send your some money from a bank to an MTN account, etc. And so you have these the spaghetti network of lots of bilateral connections between operators, and all of that's very well and good. But if Dr. Vela, for instance, wants to set up Dr. Vela's fintech in Uganda next week, she needs to now set up those bilateral links with dozens and dozens and dozens of companies. It's going to take her years to set up the agreements, fix on the commercials. She'll give up. She'll say, that's fine, I'm actually just gonna stick it out in Kenya, where, by the way, they also don't have an instant payment switch. I mean, they've got PaySolink, which is interoperable between the banks, but it's not open in the sense that Dr. Vela can't set up Dr. Vela's fintech in Uganda, and I mean in Kenya, and automatically connect to PaySolink. It's also something of a closed system. So this is a very, very important issue. Having an instant payment switch that permits interoperability between providers. It's very, very important indeed. And we're going to go through some examples of where that matters and what impact it's had in just a moment. You also need an inclusive interoperable ID. So if I can use Dr. Vela's fintech startup as an example, the ID system in Uganda needs to be open for her to be able to do KYC, do the customer due diligence, and be able to and do this instantly and easily and importantly cheaply. So some inclusive interoperable ID systems, including in South Africa, by the way, where I'm based in Johannesburg, they are starting to want to charge very large amounts of money indeed to permit this, and that's of course becomes a barrier to new entry. So then you also need to have enabling, you need to have a permissive environment for third-party relationships. So some countries have quite closed data protection laws. There's a lot of this data nationalism kind of thing going on in a lot of our countries. And that if Dr. Vela is trying to quickly and easily set up in Uganda, she's based in Kenya, or Munich, in fact, and if Uganda's right, not Munich, somewhere in Germany, I believe. So if Uganda has blocked German, hosting providers being able to, in other words, being able to host your fintech on a German server somewhere, then Dr. Vela unfortunately can't set up her fintech, can't offer her fintech services in Uganda, and this becomes a barrier to entry, and a major inefficiency. Okay, and then there are also innovation facilitators, such as, for instance, regulatory sandboxes. So what we very much want to be able to see is Dr. Vela being able to come along and to the central bank in Uganda and say, look, I've got some ideas. I'm trying to serve women. I've got a fintech concept. I think it's going to be great for women in Uganda. I don't know how many customers I'm going to get. I don't have $1 billion to set this up, but I'd like to try. Will you let me try it out for a year, up until maybe I get 50,000 customers or 100,000 customers? And then, then I'll try and get into your full licensing framework and figure out, exactly what's needed. But in the meantime, can we just try and can I try out my new products? And that's very important. So those are called innovation facilitators. Then there are accelerants, okay? And accelerants are a fast payment system, okay? So an instant payment system. So again, that's what we really, really want. So we have that in Tanzania, for instance, with TIPS. And TIPS in Tanzania is an instant payment system. It's fairly closed, unfortunately. So what we see with mobile money prices in Tanzania is actually quite high. But nonetheless, it's a fast payment system, and it's interoperable. And it's up and it's running. And that's we'll get into fast payment systems in a bit more detail. Because that's one of the areas that we're studying. So I'll try and explain a bit about that in a moment. We'd like to debate that. Then there's open banking and finance. So this is also a very important issue. So and by open banking and finance, what I mean is that incumbent holders of customer information must share that information with newer fintechs to enable them to do things like credit scoring, but also to enable them to do a whole lot of other things. So, for instance, I would just sometimes like to know, how much is my spend outside of the norm, on vet bills. At the moment, we're spending a lot on our dog who's been in the hospital. And I just like to know, is this normal? I would like to know some information about my spend. I'd also like to know, how much am I spending on my holidays? What's kind of going on? And more importantly, for my business, I'd like my business, please, to interact with my account, my business bank account, to interact with our accounting system. The bank should just share that information. I should just be able to click once and say, yep, share the information, so that my accountant can quickly assign the transactions. And so we don't spend hours debating this. I don't know if anybody here runs their own business. But we have a business, a consulting firm, as I said, and this is a very painful part of our business, dealing with accounting. And so there's a lot of aspects about open banking and finance that are very important, but most importantly, this promotes competition. So this enables smaller fintechs to be able to compete with the big guys, to be able to do things like credit scoring, so they can offer competitive loans. And then there's advanced technological tools for regulators. This is another very important issue. So, and you might think, well, what's this got to do with competition? It's got everything to do with competition. If Dr. Vela wants to set up Dr. Vela's fintech, okay, with the product for women, as we discussed, but it turns out that she's got to fill out a manual form. And by the way, there's a monthly return that she's got to fill out on the number of loans that she's put out, and so on and so forth. And it starts to become extremely burdensome administratively. This presents a barrier to entry for Dr. Vela. And so, in fact, what we want is things like supervisory technology and regulatory technology being implemented by regulators, so that interactions with licensed entities can become more efficient. Then there are digital currencies. Now, there's a lot of talk about Bitcoin and this kind of thing, and central bank digital currencies. And this is all very new, so but this can enable competition. Let me give you a practical example. So there's a lot of discussion about this at the moment. So think about a stable coin. There's stable coins, for instance, that are linked to US dollars. So a stable coin basically allows a customer to know that they can translate their stable coin, so $1 of stable coin, into an actual physical US dollar in a bank account. Now, think about what the stable coin can do for things like remittances. So if that stable coin is tradable instantly across borders, and a whole number of different remittances providers can use that stable coin, this can dramatically increase competition for remittances. And so, and again, so a digital currency or stable coins might be able to facilitate competition in that way. All right, so here is the quiz, everybody. If you could please scan this QR code. In fact, let me do this in a slightly better way. So let's sorry, just 1 second. So if you could scan this QR code in the top left of my screen, and in that way, we can start to see what people it's the questions are on what is a competition enabler. So with some of the ideas that I just spoke to you about, which of these are competition enablers? I would be thrilled if people could give some thoughts to what that is, so that we can kick off the poll. Is the poll working?
Yes, it is.
Okay, great. Thanks, Priscilla. Priscilla, have you voted? Are you able to, is everybody able to scan the QR code uh and select their answer?
Yes, I think so.
Okay, great. All right. Okay, great. Okay, so a number of people have answered. That's wonderful. Thank you very much for participating. So the first option was a mobile money price cap. Is that a competition enabler? Now, in fact, this might well not be a competition enabler. So actually, this might impede, the expansion of competition among financial service providers. Why? Because if we start to things like price caps, it might be that Dr. Vella's product for her instant payment product only works if Dr. Villa is able to charge for it. So if you impose a price cap, you might be excluding her business model. So in fact, I actually don't think of a mobile money price cap as automatically being in a competition enabler. An open governance framework for instant payments, absolutely critical. Regulatory sandbox enabling new business models, for sure. And an open banking framework for data sharing, yes, absolutely. Okay, so thank you very, very much. Thanks very much, everybody. Here are some of the respondents, and thanks very much for participating in that particular poll. So, on with the competition enablers. So, the first one, as I explained, is about tiered licensing frameworks, and what we've seen, as I said, in Ghana, the three-tier payment service provider system facilitated 46 new licenses. In the Philippines, again, a developing country, capitalization requirements were 50% lower to encourage entry. And then Malaysia also had a phased regime over 3 to 5 years with caps on total assets for the initial batch of new entrants. So you're seeing regulators experimenting with a number of different ways of opening their markets up, which I think is fantastic. Okay, as sandboxes, as I said, and this enables a test and learn approach, okay? And for instance, there's evidence of these succeeding. So sometimes these sandboxes work, sometimes they don't. Is there a sandbox in Uganda? Actually, I'm not aware of this. I'm sorry if anybody's able to comment in the chat. I'd be very pleased to hear if there is or isn't a sandbox in Uganda. But the idea is that you have a test and learn approach. And in the UK, for instance, 90% of accepted firms accepted into the sandbox, in fact, entered into the wider market after the trial period. So there really is evidence that this works. And then, as I said, advanced technological tools for regulators. So the automation of data collection and enables much more efficiency and the ability by the regulator, by the way, to actually monitor real-time issues. Okay, so Anthea is explaining there is indeed a sandbox for the Bank of Uganda and for the Insurance Regulatory Authority, which is a fantastic outcome. Okay, great. And is anybody in the call currently in the sandbox? We'd love to hear from you. We'd love to hear about your experiences if you are in the sandbox, and if so, what happened. Okay, great. Data sharing frameworks. So again, is there I suspect open data is being considered in Uganda at the moment, but is there an open data framework at the moment? I'm not 100% sure, but I'd be very curious to hear whether indeed so as I explained, so what this does is it allows financial data to be shared across providers, and this breaks down barriers and enables underserved groups to be served. So in Brazil, for instance, the framework operates on reciprocity. So if you receive data, you've got to give it. Whereas in India, there's an account aggregator framework, and that uses a consent-based system. Okay, so somebody in the chat says that there's no open data framework at the moment, but there are some early conversations, which is great. Okay, great. There's also interoperability requirements. So, and this is of course very, very important. There needs to be seamless interaction between banks, non-banks, e-money providers, and there needs to be direct and indirect participation permitted for non-banks to the instant payment system. That's a very important aspect. So let's think about two different examples. So my favorite example, of course, Brazil, where you have hundreds of direct and indirect participants in the instant payment system called PIX, and contrast this with our one in South Africa, where PayShop, unfortunately, until recently, our instant payment system was owned by the big banks. Very no open governance framework, very closed system, non-banks not allowed into the system. And you can guess PayShop is not doing very well in South Africa at all. If you ask most South Africans what PayShop is, they have no idea what you're talking about. Okay, whereas Pix in Brazil is ubiquitous. Okay, something like 90, according to a recent survey, 97% of small businesses accept payments by Pix. Think about that and what impact that could have in Uganda if you had an interoperable QR code working with an instant payment system. I think it could have quite a big impact. Okay, so as I said, you do need inclusive credit infrastructure, and I understand from the chat that there are some discussions about more open data, which is very good news in Uganda. You need interoperable ID systems. So Aadhaar had a huge impact on India. So we keep talking about India and how things are, how instant payments have been taken up there and how successful it is. But there are a lot of reasons for that, and one of them is indeed their digital ID. In Kenya, the physical ID coverage is very high, and so their digital ID rollout is not really well received by consumers, but that's because everybody's already got an ID, so maybe that's not as big of an issue. If people could comment on the chat, if anyone could comment on the chat as to how whether the ID system in Uganda is interoperable and whether fintechs are able to gain access to it, I'd be very curious to hear that. Okay, and so then from an accelerants perspective, one of the first ones is inclusive governance frameworks, and I personally think this is very, very important. So you need to have the people in the room, the smaller players, the smaller fintechs participating in your instant payment system, participating in your open data framework, in the governance discussion. So and again, this has been a massive success in Brazil. So you have the massive Itaú Bank in Brazil, right? Huge bank, millions of customers, billions of dollars in assets. Okay, and it's got the same one vote as Dr. Vella's fintech startup that's just started up last week in Brazil. Okay, it's got the same votes, Itaú Bank, as Dr. Vella's fintech in the open governance, in the open finance and the PIX governance structure. They've got a financial forum in Brazil, and that's incredible. So it's extremely open. The big guys don't get to set all the rules, and say, well, we're going to design all the rules such that actually the little guys can't really participate at all, which is in practice what tends to happen, particularly in places like South Africa. Okay. And so governance frameworks are indeed very important. So, and then access to dominant platforms is also very important. So I understand that there are some mobile money providers and mobile wallet providers using USSD on the big networks in Uganda. But getting access to that USSD at prices that are sensible, that are competitively priced, is very, very important. We actually did a project on this in Uganda some years ago. And I hope that, and from what I understand, there are some fintechs using USSD. I'd be pleased to hear how that is progressing, in fact. And super apps make this very difficult, in fact. So while we love to see all the innovation from MTN Momo, from M-Pesa, and that's great that they're offering more and more and more services in this sort of super app functionality. In fact, what we worry about is that this creates, and unless that super app is open, so unless Dr. Bella's fintech can appear as well on that super app, then we start to worry that there's going to be lockouts of fintechs. Okay, there need to be appropriate outsourcing rules for cloud services, for instance, for banking as a service, for example. So there are a lot of white label banking providers out there, and which can dramatically lower barriers to entry for a new bank. And if these get blocked in a country, then this limits entry. Okay. As I mentioned, central bank digital currencies are very important, or may play a role in facilitating competition. So, there aren't that many examples. I think Nigeria has got a central bank digital currency. I think there were some concerns with it. It hasn't been a huge success. China's obviously got one, and this can facilitate, in particular, cross-country, cross-border transactions, which, as I said, could facilitate competition in that area. And then I think the regulation of AI, of course, is artificial intelligence is a very difficult debate. The big thing that we would just emphasize from a competition perspective is not to limit it so much that it limits competition. So if smaller rivals are able to innovate using AI, it would be a great pity for central banks to introduce rules for AI that mean that those smaller providers can't innovate using it. Okay, so I'd like to now just show you some examples of where we think there are good competition outcomes and not so great competition outcomes in instant payment systems, which, as I said, play a very important role in promoting competition. As I mentioned, Pix in Brazil is one of the main examples. You've got hundreds and hundreds of fintechs participating in the instant payment system, and that of course promotes the usage of the uptake and usage of the financial system, and therefore, of course, financial inclusion and all of the economic development benefits that come with that. I just want to highlight a few examples on this particular graph. This is all data that we gathered. I see Priscilla is pointing out the position is that Uganda has no digital ID, but there's an ongoing transition for the be interesting to hear the supervised institutions as to the interoperability of the new ID. Fantastic. So for that. Then someone, Dr. Vela is asking, please could you send the chats in the general chat? Absolutely, that's great. Right, okay. So if I can just explain a little bit about what which of these countries are doing well, who's doing well, and what this graph actually is all about. So let me start there. So on the y-axis, what we have is transactions per capita per month, and this is the quarterly average. So that's transactions per person, per adult, per month in the country. So that's why we can compare across countries. We've made it per capita per month, okay? And what you can see up here, for instance, is we have a country like Ghana that has incredibly high transactions per capita per month, okay? Uh, and and so when we see that kind of number, this dark blue line up here, a country like Ghana doing so, we'd like to understand why, what's going on in Ghana, how they achieved that. Similarly, Brazil, this dark green one, they obviously had very explosive growth in Brazil, and they're doing very well. We've got Malawi, in fact, that's also doing relatively well in a very short space of time. So on the x-axis, we have here the number of quarters since inception that the instant payment system was introduced. Okay, and so that's very interesting. So we have places like Brazil doing very, very well. We've got Ghana doing well. We've got Thailand doing extremely well. Then we have a country like Peru going along quite slowly and then all of a sudden exploding. So I'd just like to discuss some of these for just a moment and just explain some of the differences. So first of all, we have Brazil that is extremely open. Okay, so very open governance, many participants, anybody can participate in the instant payment system in Brazil, and we have rocketing usage of the system. Okay, so that starts to tell us, look, if you want to have a successful instant payment system and you want to expand financial inclusion, try and think about what Brazil has done right. Um, and 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 then we see a country like Ghana, and it's doing very well. It's growing very nicely. And let's think about what's going on in Ghana. Ghana's actually, so we've included in that dark blue line for Ghana, we've included on us mobile money transactions. So those are by MTN. And so the bulk of those transactions, in fact, are in fact mobile money transactions. So not interoperable instant payment systems. The reason why we included them on this graph is because, in fact, it's the interoperable system works in the same way for on us and off us in Ghana. So it seems incorrect to just exclude the MTN mobile money transactions there. The one point that I'd like to make about Brazil is that they don't regulate the charge to merchants. Merchants are allowed to be charged, but they do regulate charges to consumers. Okay, consumers aren't charged to send money in Brazil over Pix. Now, with mobile money, of course, consumers are allowed to be charged. Or often are. So in Ghana, consumers are charged to send money across over the mobile money switch or on us, of course. And so what this illustrates, we think, at least at this stage, is that perhaps you don't need to regulate end user charges in order to get your instant payment switch to work. Okay, and in fact, to promote competition and inclusion, you want to enable as many business models as possible. And then if we look at Thailand, similarly, from what I can recall, it is free it's also unregulated, also a very successful instant payment system. Let's look at Peru for instance. I'd like to explain something that happens at about this point, this red line, as it's at about this point where it starts to really have that sort of hockey stick growth in instant payment transactions per capita per month. And what happens in Peru, in fact, is that's where they force the two instant payment systems to interoperate. So they have two instant payment systems in Brazil. They had one was called Yape, one was called Plin. The one was just the fast payments merchant system that was introduced by one big bank. The other was the other banks all setting up a fast payment system to try and compete with this one bank. And when they force interoperability between the two, so now you have a universal interoperable instant payment system, transactions explode in Peru. Again and again, so this is an example of where forcing that interoperability is a very good thing. Now in Peru, in fact, the consumer is not charged, same as in Brazil, but merchants can be charged. And again, this has resulted in very, very high growth. So I want to leave enough time. I think we only have 10 minutes left for questions. So I'd like to just I'd like to pause at this stage and just ask, are there any questions so far about anything that we've discussed? Any questions about competition enablers, accelerants, any competition problems that you'd like in Uganda? I believe the Q&A is open if anybody wants to ask a question. Any questions for now? Okay, well, please feel free to ask away in the chat. I would be very, very happy to take any questions that people may
There's
have.
someone with their hand raised, Elizabeth Atupunda.
Great.
Drake, can you see Elizabeth Atupunda's hand?
Yes, I see it. Please go ahead, Elizabeth.
Elizabeth
Elizabeth,
Atupunda.
you are on mute.
Yes, can you hear me?
Go ahead.
Hello, can you hear me? Yeah, okay,
Yes.
that's good. So I wanted to ask about the role of regulation in competition. The industry and the regulation of the industry can sometimes be a barrier to entry for competitors and also a barrier to performance for competitors. How does that stack up in the elements that you have that affect competition?
I think it's critical. I think the regulation of the sector is absolutely critical, and the regulator's got a very important job in lowering those regulatory barriers to entry. Let me show you what. Let me try and illustrate exactly what I mean. Just using one example of regulation. Do you have any regulation? I mean, do you have any specific types of regulation in mind when you're asking this?
Specifically, I'm speaking to industry-wide regulations that affect the startup of a company or the continuous performance of a company. For instance, capital limits.
Right, exactly.
Yeah.
Great question. So this is very, very important indeed. And this is a fundamental competition enabler is to ensure that licensing framework, that those capital requirements, those reporting requirements are follow a risk-based approach, so they are proportionate to the risk being introduced into the system. So let's look at Brazil again. Okay, so just to illustrate this point, these again are annual transaction volumes per capita. Brazil is rocketing, okay, up here. So they're doing extremely well. And what did Brazil do? Okay, so in 2013, they introduced this new payment service license category, or it was a similar license category for newer entrants. And what they do is they say, well, we'd like to actually open this whole thing up and we'd like everybody to apply. And so they get some applications. And then what they decide to do is they say, okay, we've got all these applications. It's going to take us 12 months, 2 years to set up, to follow the process and to get the approvals going and everything. In the meantime, you can go ahead and launch your service and we'll just monitor you as you're going along. So Brazil took this very, very open approach to licensing requirements, to capital requirements, and to say, well, you know, your capital requirements are going to grow as your business grows. So we don't set a minimum floor. So I don't know, what is the minimum capital requirement for a bank, let's say in Uganda, Elizabeth, or for a payment service provider? What is the minimum requirement? Do you know, Elizabeth? Okay, so maybe if anybody knows in the chat, if you can drop it in, I'd be very curious to know what is the minimum capital requirements, because Because this is a fundamental barrier to entry for
Apologies.
smaller. Go ahead.
Apologies, Dr. Ryan. The minimum capital requirement for tier ones is 150 billion Uganda shillings.
And how much
Then
is that in? Sorry, forgive my inability to convert quickly, but how much is that in dollars? Do you know?
I have to convert. Let me see.
150 billion, you
Indian
said?
for tier one. For tier one, 150 billion Uganda shillings for tier one. I just
Okay. And that is wow, $40 million. I mean, so that's a massive that's a massive barrier to entry. So I mean, I very much agree with you that is a substantial barrier to entry, and so that needs to be thought through in Uganda, to perhaps starting with a sandbox approach to try and say, well, look, we're just going to let you in. You don't have to pay any money. We don't know if your business is going to work or not. So let's first see how it goes. Then we can talk about the capital requirements as your business grows. That's the kind of thinking that I think they would have applied in Brazil, and I think that's very important to recognize. So yeah. Oh, it's about 40,000 US dollars, not 40 million. Sorry, my conversion was terrible. I thought you said it was 150 billion Uganda shillings. Is it 150 million maybe Uganda shillings? Okay.
no, 150 billion
Okay.
for tier one.
Right. Okay. But even $40,000, if it's my small business, $40,000 is a lot of money to me. And frankly, I don't know if it's going to work. I don't know how many customers I get. Maybe I'm only going to get 1,000 customers. That might be quite a large barrier to entry, depending on the business model. And so that's why the regulatory framework needs to enable different kinds of business models, and that's precisely the point. So if you're trying to set up a small lending business that's trying to target women in a specific region, you don't know how many customers you're going to get, and it's very important that there isn't this regulatory barrier to entry. I think that's a very, very important issue. So thank you for that question. Oh, $40 million. Okay, indeed. Okay, that's I did type in the right number of zeros into my cell phone. No, great. Okay, so thank you for the question. Very, 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 very important point. Any other questions for now? Any other hands? Starting at the top, Bruce, Catherine, Cyrus, David, George. Any questions? All right. If not, I'm just a bit conscious of time. I think that I am almost out of time, so I can happily take one more question if anybody has one. Otherwise, the one point that to leave you with is this question that we have currently in our research about the user experience by some of the incumbents in instant payment systems. So I've spoken a lot about instant payment system. They're great. You should introduce one. But what I would say is be cautious about how the incumbents might abuse the user experience for consumers in the instant payment system. And that's because let's look at Ghana. Okay, so I was trying to illustrate to you Ghana is doing so well. Many instant payments. Look how few, the dark blue line is off-us transactions. Look how few off-us transactions there are in Ghana compared to on-us transactions. And remember, there's MTN in Ghana as well. On-us transactions are booming. Instant payment system looks like it's doing brilliantly, right? But actually, that's just on-us transactions. And frankly, the bulk of that is likely to be the incumbent, MTN. And And I'm not sure if anybody's been to Ghana lately or tried their fast payment system, but what MTN does is it says, you'd like to send mobile money to another MTN customer? Okay, put the cell phone number in, off you go. Oh, you'd like to send the mobile money to another fintech? Oh, okay, or to another network. All right, which network is that customer on? I mean, I don't know how many people on this call know which networks their counterparties are on. I don't know which bank or which other provider I'm sending money to most of the time. Okay. I'm trying to pay someone. I don't know. I don't know what the details are. But or even if they do, even if they give that to you, you're now forced to put that in. Okay. And then it says, okay, thank you for telling us the network. Now put in their number and then send the transaction. So they introduce these frictions into the fast payment system that are unnecessary. So the whole point about a fast payment system is that the alias system, the address system needs to be universal. And so there needs to be universally consistent experience across on-us and off-us transactions. Again, Brazil has that. If you have an on-us transaction on a Brazilian bank, it still looks up the person's alias on the PIX system, and the transaction therefore is recorded via PIX. Okay, I've spoken a lot. Thank you very, very much for all of your attention, everybody. Please feel free to send me an email after the webinar and ask any other follow-up questions. I'd be very happy to discuss any of this with you. Thanks very much for the invitation, Dr. Valo and Diamond Advocates. I'm very grateful for the opportunity to speak. So thank you very much.
Thank you very much, Dr. Hawthorne, for the detailed walkthrough. So we are going to pause for our final break and then come back. 10 minutes break. See you then. Thank you for listening. And Dr. Hawthorne, thank you very, very much.
Thanks. Thanks again.
Welcome back from that short break. I would like to thank our participants for keeping on this call for all this time and for the time management. We are really, really on time this morning. So our next panelist, Mr. Raphael Mburu, we welcome you. Our panelist brings a regulatory perspective directly to this conversation. As I mentioned earlier, Mr. Raphael Mburu heads the Mergers and Acquisitions Division at the Competition Authority of Kenya, and will take us through the merger review process, killer acquisitions in the fintech space, and how fintech agencies are approaching the enforcement here. Welcome, Mr. Mburu.
Thank you, Priscilla. And much appreciation to the organizers of the webinar for taking opportunity to consider Competition Authority of Kenya to make a presentation and discussion on this key critical component of digital financial services. Within the 1 hour, we hope to cover as much as possible. We can bring in the scope of a regulatory perspective for competition regulator and what all this means within the large scope of digital financial services. And to start off is how we need to see DFS as being cross-cutting, that it's not only touching on mobile money and banking, because we have to look at it from a big perspective. Like in Kenya today, most of the financial elements are being digitized. Insurance, capital markets, selling of shares, banking, and all that. So there's a lot of either conglomeration or trying to have a one-stop shop from which one can easily have all the services that they require, one-stop shop. However, this is proving to be a hard nut to crack, because you can imagine right now, from a telecom perspective, I'll give a background of like the leading mobile player in Kenya, which is offering insurance services. It's offering stock buying services, bonds, healthcare, and the likes. And also give a scenario where you find most recently the director of mobile money service from the company was poached to head one of the leading banks. What does that tell you? And where the banks want to go? The entry of banks from Nigeria into the Kenyan market, and with the recent purchase of Paramount Bank, we find banks that are very highly digitized entering the Kenyan market. So it tells you that the scope cuts differently than just the telecommunication element of it. And where now we start seeing the telecom, is it the pathway for the digital services? That it's no longer that I'm looking at MTN, I'm looking at Safaricom as a digital financial service provider, but for them, they have to provide a platform for anybody to play around with. I was intrigued in the morning. I did a transaction where I was transferring money from Airtel to Safaricom. And unlike before, where if I sent money to M-Pesa, one used to receive a code and you would have to walk to an agent to withdraw that money. Now the money is actually being
Recording in progress.
Are you able to see my slides?
Yes, we are.
So you, as I was explaining that in terms of you're able to send money unlike before. So the evolution is really happening very fast. And it will call upon, so the regulators have really not played catch up, but really be on their toes to be able to regulate effectively and also promote competition, because that's the main, as earlier indicated by Dr. Kigwiru and the other presenters, that the critical role that is played by competition in any market. So it helps promote innovation, helps promote creativity, and also offer different products, services for customers. I would give a good example of how this DFS cuts across in terms of like now payments, how PayPal has tried to get it. Initially, PayPal was very complex for people. People used to have a lot of complaints. Now you find we're able to settle that with certain banks. And I'm still not able to sort a payment in China very easily, a payment in US. But someone from US is able to send money back to Uganda or Kenya very efficiently using their mobile phone and not having to walk to a bank. So it tells you the steps that we have to take for the integration to happen, but also at the same time protect and promote competition. And one of the critical components we find like now in Kenya is in terms of the fragmented regulation. You have CAK, that is Competition Authority, you have Central Bank of Kenya, you have Capital Markets Authority, you have the Insurance Regulatory Authority, you have CMA there inside, that everybody is regulating the same sector, different elements of the same sector. Communications Authority is also there regulating the same. So it's very hard. You can imagine right now, for instance, a digital lending company in Kenya, it has to get a license from Central Bank of Kenya. First of all, it has to be registered. From what they operate, they have to go to CA to get a license. If at all they are to undertake a merger or a certain cooperative practice, they have to come to CAK for clearance of that. If they start offering insurance services, then they have to get another approval from Insurance Regulatory Authority. And this cuts across board. So it tells you how that fragmentation can easily also hamper growth and how the regulators really need to speak to each other in terms of easily being able to fast track such investment. Because one of the things I always say as a regulator is that our work is not to delay investments, but our work is to promote investments in any economy. And by promoting them, we're also ensuring that we are maintaining competition in that market and it's inclusive and all that is happening in a contestable market. Some of the things is how CAK has addressed exclusivity, access bottlenecks, and information harms. And one element I would like to point out in this whole landscape is the role that in every aspect of regulations and everything, that data protection has come in as a very critical component of digital financial services. So as regulators are looking at what can they do, you have to fall in the back end of knowing that data protection becomes a very critical component. The cases that are there in court every day about data protection in Kenya are countless. If you go online, you find enough cases. And these cases have a very big implication in terms of, for instance, even as an authority, we are considered a data processor. So there are certain regulations we are supposed to comply with when we have that. So from there, if you're putting remedies, if you're directing how companies should operate, it needs to be very critical on how you tell them that you do not breach those data protection laws. So for instance, if you are saying that there should be interoperability, are you thinking about data protection behind that? So that's a critical overcutting component that I find is very critical for us to also have in mind as we're having this conversation. And one of the factors that are helping this to grow in Kenya, one is the high mobile internet penetration, then dominance of mobile money and the shift from physical to online retail. A key thing you'll find about the Kenyan market is that once something has come up, people are very receptive to new changes, new technology. And I also believe this is coming in with the growing population of the younger generation in the national economy. It has a great impact on them to incorporate that. But I see right now, the last time I visited a bank branch, I think it's months, from almost a year. And even when I need documents to be signed, I would easily tell the person, deliver the documents, I'll send you a scanned copy. Why are you not sending me just the soft copy? I print, scan, and send it to you back to the bank. So if you ask someone, where is your bank account located? Some people may be making mistakes. Unlike before, where visiting the bank was such a critical component. Remember, like what I indicated earlier, that now with the new banking platform for payments, that with the banks, you're able to do a transaction any day, 24 hours. Transactions that were limited before for only, actually before it was limited for 6 hours. The settlement for TGS used to operate from 9 a.m. to 3 p.m.
Recording in progress.
When registering your online application, you really need to have a link to your phone that will be acting as an activation when you are linking to it. So it tells you that the internet itself is not enough. Your mobile plays a very critical role. Most of them are very highly creating very high-end mobile apps that you need to use on your phone. But rarely will you find that you can just use the internet alone without your mobile phone. It also serves as a backup and security. For instance, when you send money from one account to another, you get an SMS. It acts as that surety to know that that transaction has been concluded. You receive it. And even when you are being asked for verification, I was laughing the other day when my bank was asking me to verify my last 3 transactions, and I was telling them I can't get them often. But they told me, just go to your phone and check on the SMS messages. That's what we are trying to find. So the bank is also verifying you have the phone that is registered to this account there, because you're supposed now to give the exact amount, the exact time, and all that happened. I've also seen an element of one of the banks where they tell you to do video chat with them. If you're trying to have, for instance, when you're outside the country and you're trying to get your link for either reactivation of account or something. So through that video, they are able, first of all, to do facial recognition. They're able to tell you that, for instance, if the person on the other end know that that's not a recorded video, they would ask you like questions like shake your head 3 times, do that to actually certify that it's you. That's how much that technology and also access to internet means. Because without such access, it's very hard for you to be able to do all those elements of verification and everything. Then integration of other services. And I had earlier indicated this in my remarks in terms of like now, for instance, how your online platform is linked to your mobile phone. And CAK has always taken a pragmatic approach rather than a prescriptive one. I'll give a history of when Uber came into Kenya, and something that we are very proud of. But then there was a lot of hue and cry from the traditional taxi, and they indicated that we need to regulate. We cannot allow this competition. And that question had been asked earlier in terms of, you really heavily need to regulate so that you ensure there's competition. Sometimes you don't even need to regulate at all. That's also a solution. Like, regulators are not there just to ensure that you are regulating. But also the other thing I find being a challenge is that you are creating so many laws to try and cover each and every element of technology. Yet technology is moving so fast that those laws will always be playing catch up to the technology. So you find in 2 years, your laws will easily be outdated. So at that time when Uber came in, Kenya easily said, Competition Authority was put around. There was, I think, a committee that had been put around, a task force, and CAK said that we really need to just sit and watch what happens to the market. And it doesn't mean that you're not doing anything, but you are really monitoring and checking how is the penetration of this thing happening. And within no time, we found out that actually Uber coming into the market was giving people better services. How are better services being implemented? Because now I just need to sit in the office and ask for a taxi. I find a taxi that is clean, a driver who is polite, and I'm given a fare, a price that I'm able to see already the price. Even if I call my ordinary taxi, when they come to where I am, they give me that leeway to be able to negotiate, improve on their services and the likes. Then over time, we have seen emergence of new taxi hailing apps. The same traditional taxi drivers started now coming into associations and creating their own apps. And we have grown to a point where now in Kenya, we are seeing that even some of the taxi hailing apps have gone regional. So you find their taxi hailing apps operating only in a specific town because they know the specific needs for that town. Ultimately, now where we are in Kenya is where now the taxi hailing apps have formed an association, which now we have to check them under restrictive practices that the associations do not start fixing prices, dictating terms. And also it brings a very interesting concept of which Dr. Kigwiru has always mentioned in terms of labor markets and how do you consider the drivers to be employees. So if at all, for instance, you are doing a transaction that is involving a tax hailing app being bought by another company with their margin, can you put conditions around employment, around pricing, how do they relate to each other, data sharing, all those things now come into force. So that's how much you find at some point when you say that I will allow this to happen, but then over time, allow for regulation now to start coming. And there will be elements of regulation that will come in at that point. In terms of M-Pesa agent inclusivity, this is another element of previous intervention by CAK, where initially that an M-Pesa agent was not allowed to have any other agency operations within them. That means that if you have a shop that has an M-Pesa, they can only be M-Pesa. Over time, this has changed because we had told them they have to open up those agencies to other players. So nowadays you find an M-Pesa agent will have a banking agent. He's a banking agent for almost 3 or 4 banks that operate agency. They have Airtel Money, and they have also their ordinary business that is going on. And what we are seeing now, actually now what is changing, it's even aggregation, which is another critical element for this. And it's something I would like to mention, where you find now the M-Pesa agent is now linking up, that agent is linking up with PesaPal to ensure that they are aggregating all their transactions on one platform. If previously you'd go to like a petrol station, and we had a very interesting transaction where one of the leading oil marketers, Total, was buying a technology company that provides aggregation services. And what are they looking at? If I go to a petrol station, I can pay via cash, I can pay via my card, I can pay via M-Pesa, I can pay via Airtel Money, or I can pay also using any other means that is available for me. But the owner, the retailer, was not able to get all that money aggregated in one point. You'll find the cards are providing the money after 3 days. If I'm dealing with Bank A, Equity, if I'm dealing with the MTN, if I'm dealing with the ABSA, everybody, if I'm dealing with Stanbic, everybody credits within 3 days, 5 days. So there's no constant time that you'd say that they have all their money and they can say these were the sales for the day and they have the money in their account. Aggregation has become a very critical component where nowadays, I'm able to say by the end of the day, all my money is in one account because the likes of PesaPal, Connect, and the other payment platforms, YPPay, they are able to put all those transactions under one system, and that you would say that today you made your sales of, let's say, 10 million for 50 million or 100 million shillings. So with this remedy, at that time, it was the most open up to others. But now you can see as you're opening up, as the technology is improving, you are going back to the same level of now aggregating because you need the money in one platform so that I can pay my supplier. You can imagine an oil marketer who needs money to pay. Maybe they are given 7 days credit period, 20 days credit period. They need all their money aggregated at a specific date so they're able to make the payment and purchase for that. When it comes to now the specifics of mergers and acquisitions, they are clear defined thresholds which transactions would we would rely upon to ensure that to check whether a transaction is notifiable or not. And a key critical component of this you may find at times is that most of these companies, especially startups, they may have revenue or have very minimal assets that they don't fall under the scope of thresholds. This has been a big discussion globally. And in terms of why we move away from thresholds, we are looking at transactional value. That's a school of thought that has been put out there. Would look at what would be the effect for this if a very small company has been bought. Then on the flip side, the other conversation we also needed to have is, what if Mr. Mboro came up with an application purely to sell it? That's how they intend to make money. Because you have those hubs that have come up, like think tanks, where they are developing applications every day. And when the likes of Facebook, Google, and the likes see whatever that has been developed, they're able to pick that. So the transaction value, is it a very, really good quantifiable measure to say, what is this transaction worth? And then again, if there are anti-competitive practices that are to arise in the future, is the law robust enough to cover those practices? If, for instance, the person starts abusing their dominance, and now that's why the conversation is changing, which is what I will discuss later. The conversation is changing to looking at things like superior bargaining position, strategic market position, because mergers alone, checking at this time, you cannot confirm that every merger, because a company is being bought at a very high value, that it has impact. And I'd also take you back to the conversation we're having about sitting back and watching. I remember when Starlink was coming to Kenya, there was a very big, on one side, the market was very receptive. People were waiting for who else is coming in to compete. The dominant firm was very critical of why are they not being regulated like us? That was a conversation now. But over time, the latency speeds and the times for connection, the much hype about it started going down because the consumers are no longer demanding for that product. So it's more also in terms of entry and there's demand, because if there can be entry and without demand, the product is as good as useless for the consumers. I'm not saying that Starlink is not doing well, but you can see over time, the spike happened and then now it has stagnated. And you find even the other firms start now keeping quiet because they find, oh, consumers are not moving. And that's also the element you find as a regulator. If you are very quick to regulate, to say, this person this should only come in at these terms. And how this regulatory framework is very different, because you find like now when the government of Kenya was selling its shares in Safaricom, one of the waivers that they have been given is about the renewal of the license. So the same regulator that was complaining about a license for Starlink is now gaining the same favor from the government, the regulator that is responsible for that. So it's a very big balance where you have to take that, what the law says and where do we stand as regulators in terms of things like thresholds, competition, and how it will be affected, and what would emerge. And the biggest mistake we make is doing a copy-paste from Europe to our markets, because our markets are very different. Keep giving a good example of East Africa. If you look at the cost of switching, if there was no Android, I would say that would still be very much far from mobile penetration, internet connectivity. Why? If today you go to every village, you can get an Android phone for $50. But I can assure you there will be no iPhone for $40, $50 anywhere. So if at all today that we are to rely on iPhone alone, penetration will be very low. You've seen how that technology has really helped even small businesses emerge. Look at things like TikTok, how it has helped very small businesses. Before, what was the cost of advertisement? A normal 10 seconds advert in the TV costs not less than 200,000 shillings. That's around 40 or 50 million in Uganda. But with TikTok, a small business is able to advertise for free. But now we start also asking the hard questions. Is the advertisement really for free? Is the data collection for free? Is this company growing big? Then also now comes to the other issues that we are saying that the regulators have to come together, all of them. We are looking at child protection rights, data protection rights, all those. So as regulators, we have also to rethink and see beyond just regulating, to say that you're protecting markets, you're protecting incumbent, or you're trying to enforce competition, but you end up also creating more harm. I'd go now to a case example for Kenya where we had recently, and this was KCB Bank acquiring Riverbank. Riverbank here is not a bank. This is a company that offers innovation, technology for banking system. And how this works is that you normally have ordinary banking system. The banks have a regulated system that now they call it, I think they call it T24 is the most common system that is used for banking. However, banks have agents out there. And these agents are doing the same banking transactions that are supposed to be done within a branch. But these banking agents cannot be connected directly to the banking system. Why? Security, data protection, all the issues we were raising earlier. So now, Riverbank offers a solution where they aggregate everything that is happening within the agents and connect them through one line, if I may use very basic terms, so one line to KCB Bank. Therefore, it's ensuring that the moment you do a transaction at an agent, that transaction is reflected in your account immediately. But it's two systems that have to speak to each other. That's what we learned the transaction was. But prior to doing this, for us, we were very critical as a regulator to ask, why would you be buying this technology company? Who else are they offering the services to? Are you trying to prevent anybody else gaining access to these services? Is there something that you have noticed that they have as a provider for systems that you want to lock in? And especially when you have told us they offer services for agency banking. And if you look at the submission the parties had said is that the agency banking competes with M-Pesa agents. So actually, KCB buying this wants to compete with the agency banking with M-Pesa. Now, the traditional bank is competing with a mobile company offering digital financial services. And you get a very clear case of you saying that for this transaction, it's actually a good thing for the market because agency banking, how will it help promote banking? That everybody is able to aggregate. And because they also be getting remember the machines I said that does aggregation, they are getting those machines. So that they are also able at that small kiosk to have a one-stop shop where they are aggregating their transactions. They're able even to aggregate the M-Pesa transactions to the same system and they are being reflected on their bank account. So essentially now this person does not have to rely only on M-Pesa statement where their transactions are actually aggregated under another bank, NCBA, or whichever bank they choose. Now they have a choice for another bank. So the next question we asked ourselves is, how much has this penetrated? And we find that actually Riverbank was running over 80% of their transactions belong to KCB. Therefore, essentially they have just been running KCB business. So from our analysis is that we were able to ultimately say that this transaction that we allow them to go ahead, but because of these people who are operating outside the 80%, this is where I wanted to go to in terms of data protection and how infrastructure is protected. That the person who are running outside here, because we don't know who they are, and we don't want them to be forced to integrate to this banking system and they need still to continue enjoying the same services, that the transaction was approved. However, that party transaction, customer merchant data collected by the target infrastructure was kept out of the system, meaning that, for instance, if I'm not in KCB and I was using this system before from Riverbank, I will not be obliged to go to KCB to aggregate my system. So essentially, if I grow big, Riverbank has to continue offering me that solution, whether the company is owned by KCB or not. And from that perspective, I would say, if you look at a global perspective, much of the transactions you have had are in the banking sector, that you find it's not that element of digital financial service to digital financial service being bought, or it's funding that is coming in. So you find someone is coming in to put in funds for branch. But we had one very interesting transaction where a traditional bank, a small bank, was buying a digital lender. And the same question about aggregation came up, that could this small bank use the data they have from this aggregation, and from aggregation of this data, be able to discriminate people based on their credit reference. And one of the things we had to make very clear to ensure in that transaction is that you cannot do the aggregation of data for whatever is in the mobile lending app to the main banking system. If at all it's the same customer that you have for that, you cannot discriminate a customer based on that. So if the bank has a credit history that it checks for you as a customer, it should use that. But it cannot use whatever you have on your mobile to discriminate you now on the banking system without telling you as a consumer that this data we are transferring it to this portal, and now we will be able to check on your credit. Then also, you don't force the customers to migrate, because you may tell now start enticing the customers and telling them, if you migrate to this, you get better rates, you get 1, 2, 3, 4. So it's like you are using a bait for the customers to move to your platform. And there is a transaction. This one will be shared in the presentation that we had for Network International Holding PLC and BCP. Then in this case, then there were no vertical foreclosure risks that were seen. Although this was also in the digital payment infrastructure, this is a commercial transaction. Innovation and digital competition were unlikely to be harmed. So you find in these transactions, most of them, as I've indicated, is that we are still at the early stages of first round of investment. We have not started the actual consolidation. And also something we find interesting in this is that just like the banking sector, they are very fragmented, so that you find the person who has the biggest market share will not go beyond 20, 25 there when it comes to these elements of now offering digital services. Then the next thing I would like to indicate is how the law is evolving in Kenya. And this brings to where we are right now, to enhance regulation in the digital markets. We started by 2016. This is just a brief history where we brought in buyer power. You'll see now as you're moving to digital markets, how this is also changing now to become superior bargaining position. The merger threshold is also very critical, because as earlier indicated, do we need to reassess our thresholds based on these transactions that are coming in? Then shift from criminal prosecution to administrative remedies is also critical in terms of these companies now when they commit anti-competitive practices. Are you going to prosecute these people in court? Or are you taking penalties to penalize them? And now this boils down to what we have as Competition Amendment Bill 2026 right now. A critical thing I would point out here that this process, if you have been with us before, you would find that it was indicated as Competition Amendment Bill 2024. And this is the biggest challenge we face with the current setup of law, and that the amendments do not, law creation does not follow. It should be faster than how technology is moving. But now actually we are just playing catch up. So if you can imagine a document that went to stakeholders in 2024, we are now 2 years later. A lot has happened within those 2 years. So the risk of you actually regulating something that has already been passed by events is very high. But in this case, what have we been doing is that we have been talking to our stakeholders. We don't keep it close, but we keep on trying to get in more, what is more that can be added to the bill. Right now, it's currently before Parliament, I think, under second reading. And there is the creation of strategic market position and introduction of superior bargaining position. I'll briefly touch on strategic market position. And this was earlier discussed in terms of from the dominance perspective. Because when you're dominant, you are the market leader, you're able to exercise your market power. You have certain market shares above 50%. But now you may have a certain position, especially as a technology company, that you must come through me. Take the likes of, we have said in Uganda, we have MTN as one of the leaders. I have a critical infrastructure that you must come and use at that point. That I'm at a position where you, as any person who is coming in, that as much as I'm not dominant, you need me in that market. Because remember, dominant was calculated in terms of market shares and how much you're moving either your goods or services. Superior bargaining position, same element. Instead now of you just being a buyer, that you are able to influence. For instance, if it's an online marketing platform, Jumia, Kilimall, I'm able to say that your product will be for you because you are selling this product, you have like 100 phones. I will set the price for you. That your phones can only be discounted up to 30%. Then all your payments, I have to stay with them for 5 days. I aggregate your payments in these terms and everything. So I'm not actually buying your product. But because I'm giving you a platform, I'm able to negotiate certain, and you require me because I'm a big player in the market. I'm Jumia, you need Jumia. And you see, as a small player also, you're not able to place your products in Jumia, Kilimall, and the likes. But if you go to someone like a big company like Hotpoint, I don't know which would be a big company in Uganda for electronics, that you're able to easily place your products in different platforms, even your own platform. But here, as a small business player, you are disadvantage that you have to place your products in one platform. So the main purpose of this is try to regulate digital platforms, protecting the smaller businesses, and also enhance the authorities' oversight and update definitions for evolving economy. So generally, in a nutshell, you see that the authority has moved from a point where regulation we started from a point where we didn't have thresholds for anything. We had criminal sanctions. I think it started immediately from pricing. We started from a point of controlling price, because initially it was called the Prices and Monopolies Commission, where you are fixing prices and setting prices. With the liberalization of economy came now free markets. And the first instance was soft enforcement. You're allowing people to learn there's law. You are trying to tell them comply with the law. Why am I going through this journey? It's because as Uganda is implementing its competition law, there are two also critical elements of it in terms of first allowing the law, people to understand that there is a law. If you look at TAC Competition Authority came in just the other day, and I think by now they have already assessed around 10 mergers from the date of it, less than a year. 10 mergers have already been notified. It means the advantage Uganda, EAC, and anybody coming right now has in the market is that the market already is aware that competition regulation is happening. Unlike when Kenya was coming in 10, 11 years ago, 15 years ago, sorry, when it was not well known what is this competition law. Because you can imagine the whole of East Africa, it's only Kenya that had a competition law by then. The next way you find a developed competition law was in South Africa. From there, we went now to hardcore enforcement, where we are telling people that you cannot abuse your dominance, you cannot abuse your buyer power, you cannot implement mergers without approval. Where did you implement this merger without approval? And now from there, now we are going to the next phase of now looking at digital markets, the bigger scope of it. How do we ensure that competition is maintained within the digital space? Thank you. I'd like to stop there and now take any questions.
Can I ask a question?
Yes, Dr. Bella.
Yeah, just a quick one on the Competition Amendment Bill of 2026, because you've indicated that since 2024, a lot has changed. And I'd like to know how it fits within the Commerce and the FCFTA competition issues relating to digital markets. How your amendments fits also in the Commerce amendments and the FCFTA provision.
Thank you.
The alignment.
There is actually what we did from February. We have formed a task force that has, I think, the second sitting. Because what we are waiting for, once the stakeholder, normally how the law we go about is once the law has been taken to Parliament, we call in now for stakeholder input through Parliament. And a critical component of that is us being able to sit together with the Committee of Parliament to try and also within those amendments, first of all, guide the committee on why the amendments are necessary and the likes. Because once the bill has gone to the CS, that is the minister, you cannot change it again fast. It has to go to the AG, goes to the minister, now goes to submitted to the Parliament. What we have been doing with the COMESA and ACFT is that we have formed a task force. That task force, for now, I wouldn't want to disclose exactly what they have put into place, because the stakeholders themselves may also have input on the same, because what we have received a lot of stakeholder input after we even closed that part. We have been trying to have those meetings. Then there's also a lot of geopolitical changes, which I would say the way World Bank was facilitating certain processes before, our international partners, the pronunciations from some of the countries, where they stand in some of these things. You also look at the bigger political scope of it, linking it to ACFTA, competition policy, linking it to to COMESA regulations, the new regulations, and more they're looking at digital financial services and digital markets. The definitions they are putting there, are they good enough? Then also now we also have the leeway of checking what is being implemented, like the recent cases that are happening in EU. What are the silent issues that are coming up? If at all the issue is about how do you say that these are the days digital platform, this is who and who, these are my strategic market position, are you defining it in the right manner? So all those things is what we are looking at currently, and we'll have a proper submission on all that, because what we have realized is that you may think that you have the right definitions, you have the right scope, but you are a bit off. And will it be practical? No. Can it be the right thing? Yes. Or do you need to drop that whole concept and now make it simpler for utilization in the country? So that's a process that is ongoing, and we are really looking into how to ensure that that is incorporated. But the tricky part we have is we have to convince the Committee of Parliament within a very short period. And it's like now taking amendments to our own amendments because of the time lag. That's the really difficult part that we face.
Just another
Thanks.
final question. You know, this is my area. So if you were to advise Uganda, because for Uganda, instead of having separate provisions on digital markets, they've embedded the regulation of platforms in the digital market under the abuse of dominant position. So do you think this is something they should look at, or the abuse of dominant positions, the provisions on abuse of dominant position can be used to regulate digital markets?
See, I've seen cases in the African continent that have touched on digital markets, and nobody has amended their law to say outright that we need a new law so that we regulate this. I believe even with the current existing laws, you can still review cases. The cases I've said we have done in the past with the Safaricom and everything, and those are years way back. We never needed to amend the law anywhere. That's why I find we don't need really to think that the law is the biggest stumbling block, but a critical component of us being able to regulate digital financial services and digital markets would involve having very serious market research. And our market inquiries, where I like what South Africa is doing and how in their amendments, they really enhanced their market inquiries, because the recommendations for market inquiries can really transform things. And like when you just say, and it will go away because it's a consultative forum that consultative process that you have for market inquiries. If I go to Uganda, you'll find, and I'll tell you, it's like now as you're starting, the biggest obstacle will be the big companies that will come and say and try to show you that this is not the right way to implement. And you have not even defined the terms, known it well, and now you're being forced to have very serious conversations, which actually go to the very highest of level. You find political pronunciations being made in the biggest of countries regarding certain laws. So that's how much critical it is for them. You have seen what has happened with South Africa, with Starlink and all that. The comments that are made at that point. So it's really something that, as you're starting, start with what is possible at the moment, but also on digital elements and everything. See how the law can actually easily be used as it is on soft enforcement as you go to hard with that. You are bringing in people on board to understand that there's a new sheriff in town.
Thank you.
I've seen there's a question on the chat. The notice of the minister before the merger and acquisition, does it apply to all business sectors? Also, which ministry is in charge? Does this happen really in Kenya? Do companies really comply with this provision? This is from Teddy Nakamwe. I would say, from my understanding, although I have not, and this one I would ask Dr. Kigwiru if at all you are much more familiar with it, is that in Kenya, the notice really does not come from the minister. Kenya, we have the authority is the one that publishes the notice, is the CAK that publishes the notice. But with the setup that is there in Uganda, it's the minister who publishes that notice. Yes, it applies to all business sectors. The competition law does not, unless it expressly says that we do not relate with this sector. If at all you're conducting business, you're engaging in trade. For my reading of the law is that if at all you're engaging in trade, even government institutions that are engaging in trade, they will become, they have to comply. For instance, if an entity that is engaging in trade and making profit is selling, there's a change of control, then they have to comply with that regulation. Dr. Kiguru, you have anything to add?
Not much, apart from, I think, for Uganda, they do not have an independent competition authority like Kenya. So that's why these notices have been made by the minister. And also, just as we said, unless there's a sector regulation that or law that, like communication, that explicitly indicates that mergers should also be filed by the sector regulators, all mergers are usually filed by the competition institution. Yeah.
Thank you. If
There's no other, then we can go for a break.
Okay, thank you, Mr. Mburu, for that perspective. And no, we don't have a break right now. We had planned to just move on to the next module, the final module, which is yours, Dr. Kuguru, to handle. So over to you, Doctor. The module is about managing investigations and enforcement risk.
Okay, I thought we are having a break. So I really wanted this to be very open, and therefore just to ask questions and maybe to share a few slides on how we can have an effective compliance program. So don't tell me Mr. Mburu has stepped out, because I wanted to start with him. Maybe I can start with Dr. Paello. If you were to advise the participants of the digital financial sector, what would be some of the do's and don'ts that they should take into consideration?
Thanks, thanks, Dr. Vela. So, of course, this is all very new, but I'm sure that for the market, they've already been recognizing a lot of these things. And I think there's certain conduct that they might have been engaging in without much knowledge. But now with the Act coming into place, with the regulations in place, and given the priority position that digital markets are being given, I think it's important for them to get comfortable, or at least try to understand as far as possible how these regulations can affect them. One of the key things I think is that it's very easy for in terms of, because one of the key things in the fintech market is that we're going to require access, and in many cases there will be collaboration. And I understand FitSpice here, so allow me to also be a bit candid. We've found in certain institutions, in certain cases, in associations, it can get very easy for people to get comfortable and to share information that they should not be sharing. So that would be one of the things that I would caution about. We found that in certain cases, in associations, people have, this is where people have either made decisions to collude or tacitly collude. So it's just about starting to prepare yourselves and kind of, I don't know, I don't want to call it hygiene or cleaning house in terms of the interactions, just to be aware of that conduct. The other is, of course, now many of the fintechs have already experienced in one way or the other some of this exclusionary behavior. So they do have an opportunity to raise certain challenges, or to raise concerns, or even to ask for advice in terms of what they might be experiencing, what they might be facing. And then on the other hand, there are also other dominant providers. I've talked a lot about the telcos, but I know that even within the markets, for instance, I know there are certain aggregators previously, and this is a bit dated information, there were, I think, only about 5 aggregators that were allowed to provide certain services. That also is a level of concentration, and that has impacts on other firms that may be accessing inputs. So it's also keeping in mind that some of this conduct or anti-competitive conduct may not only be involved with some of the extremely large players, but even some of the intermediate providers in the market. So being aware of that. Yeah, so I think that the goal here is fair competition. It's of course we want them to compete. We want firms to compete fairly in terms of innovation, in terms of investment, as much as possible, innovate, invest, improve the product and service. And I know also that FITSPA has a code of conduct that includes some of this. That includes conduct, how their behavior within the market that might be useful. But yes, just to check on themselves and to watch out for this behavior, where necessary, seek out advice and recommendations from the market.
Okay, thank you so much for that summary. I can see Mburu is not there and Ryan is not there, so I'll just go straight. So, and as Claire said, the first thing you need to know is to understand the regulatory framework, where she has identified in her presentation some of the barriers to entry, including regulation, strategic, and so on. So here I'll just go through some of the provisions in the Uganda 2025 competition regulation for you to understand why we thought it was very important for us to have this session and why compliance is very critical for those participating in the digital financial market. So, I'm going to look for my presentation. Okay. Sorry for that. So I want to highlight some of the sections in the 2025 competition regulations of Uganda that I find very critical for us to know, because the first thing you need to understand is what is it that you are complying with. So just as I was discussing with Mburu, under the Ugandan competition law, so they don't have separate provisions on digital market regulation, but then they're going to use their abuse of dominance provisions to determine whether the specific firm in the digital financial sector is engaging in uncompetitive conduct. So I'll just show you some of these provisions so that you're able to know what exactly are you complying. So when you look at Article 7 on determination of dominance in a relevant market, and this is exactly what Antea has been talking about, and Ryan and Raphael and I as well. So the regulation identify, and the law also identifies that it will regulate multi-sided markets and network industries. And therefore, when determining the relevant dominance, they'll be able to consider the existence of direct and indirect network effects. They'll also be able to consider the economies of scales and the undertaking's access to data. That means that they'll be able to evaluate the digital market characteristics of the Digital Financial Services Act. So as a firm, you have to ensure that in your compliance program, you take into consideration these issues, and we are going to look at them. And then when we look at Section 18, before the involvement of digital markets in the traditional market, when we're measuring dominance, most competition agencies used to rely on market share. But now, Most competition agencies are not just relying on market share, that you have a 30%, therefore dominant, or you have 40%. No, they go beyond market share. And that is exactly what the competition law of Uganda has embedded in. So market share will not be used only as a parameter, will not be used as the only parameter for determining a dominant position. But according to this section, they will look at other parameters, including non-price parameters. And in this case, it's usually data of the inability of consumers to substitute the products or to switch to another product. Very important and very critical is Article 19. I hope everyone can see this. Article 19 of the regulation, which identifies the specific entry barriers that the technical committee will look at. These barriers, they were discussed by Ryan and Antea, regulatory, strategic, legal. Under subsection 7, we have now the factual barriers, and they can include structural, strategic, technological, and so on. So the issue of interoperability and blocking competitors from accessing critical infrastructure is one of the factual barriers that the technical committee will look at. So in compliance program, you have to also ensure that when it comes to agreements, whether you're the provider of the infrastructure or the input, or you're the competitor that is trying to also access that infrastructure, this is one of the issues that the technical committee will consider. Economies of scale or scope, exclusive or privileged access to essential inputs, natural resources or key technology. If you've been following key developments in the European Union against Apple and access to Apple iOS, whereby Apple was trying to block other competitors from accessing its NFEs and its APIs as well. But the Competition Commission was like, you have to open up so that other competitors can be able to access and operate. So they also look at the customer switching costs, including those that are related to network effects. So in addition to that, very important also is this section on countervailing power, which really reflects also what the competition authority is regulating on a superior bargaining position and also abuse of buyer power as well. So, and you can see the ability for buyers. So if it's an e-commerce platform, the ability of buyers to switch, not to switch. And you know, in the digital financial services, we are not just looking at one market, it's an integrated market with the digital ecosystem. So you may find that if you're using Kilimall to purchase goods, and Kilimall also have a payment structure, they may ask the suppliers only to use their payment structures and not allow them to steer their customers to other alternative payment structures. And this is exactly some of the issues. So Article 21 is also another issue that when you are putting down your compliance program, you should be able to also understand exactly what it means by refusal to deal. And this speaks to access to infrastructure as well. We've had a lot of cases in Brazil against Meta, in India against Google Pay, and so on, whereby they refuse other competing payment providers to access their infrastructure, especially the operating system. So, as Antea said, if you need advice, this is some of the things that you should be looking at and asking for legal advice as well. So I don't really want to go into the detail, but when you also just look at Article 21(6), it all looks at how this refusal to deal in the digital economy will apply. For example, in the case of digital economy, the Ministry of Technical Committee shall, in addition to the conditions set out in this regulation, regard unjustified refusal to supply or grant access to essential data, networks, or infrastructure facilities which are not necessarily accessible on reasonable terms to another undertaking as an abuse of dominant position. The tying arrangements as well, we've talked about it. It really happens in the digital financial services market, whereby you as just said, as a supplier or as a business operating on an e-commerce platform, that you have to also use their platform, their payment infrastructure as well, if you want to operate on that platform. So of course, also Section 23 becomes important on predatory pricing. So the reason I'm talking about this is because the digital finance services market of Uganda, the main stakeholders are the big tech companies and the large banks. So as a fintech startup, competition agencies rely on you to come forward and let them know what is really happening in this market. If there are entries and barriers that the competition agencies can investigate as well. Because if you're not able to identify these issues, then competition agencies will not be able to know exactly what is happening for them to be able to help you to enter into this market. Also, when you are entering in strategic partnerships, so most of the big tech companies are doing, instead of mergers, because they know the competition agencies might scrutinize them, is to have strategic partnerships whereby they can have a data sharing agreement. So in this case, if you're having a data sharing agreement with a bank, or if a bank wants to incorporate your fintech service into their payment system, what exactly are you looking into so that you can be able to comply with competition law? So the final section is now on Section 24 on exclusive supply and distribution of agreements. So just have a look on these regulations, what is required, and if you need legal advice, of course, Diamond Advocates is there for you to provide you with the best legal advice on these emerging issues. So in this case now, you'll allow me to look at some of the do's and don'ts some of the issues that now you can have a look at as you try to comply with all these provisions related to regulation of digital markets in Uganda. And don't forget the commercial competition regulations, Regulation 36, 37, 38, and Article 11 of the FCFTA competition protocol. So one of the issues, and I really like the presentation from Anthea and Ryan, that was really bringing out all these different regulatory approaches in the digital financial services. So you are not only complying with competition law, we have data protection laws as well. We have the laws in the banking sector, in the communication sector as well. So the first thing you need to understand is the entire regulatory system within your country. And because of the cross-border nature of digital financial services market, you also have to look at all the other regional competition agencies. Now we have the FCFTA digital trade protocol. So you must really do an analysis of all the regulatory frameworks that you need to comply with. But then when it comes to competition law, now the first thing is to identify the competition issues, the prohibited conduct, and then go into detail, because every anti-competitive conduct has its own legal test. What you need to prove, what is the theory of harm, what is the causal link. So you must really understand what is on. So what exactly are you complying with? So specific to these markets. So After you've identified the issues that are related to competition or consumer protection, you also have to identify the risk areas that may make it conducive for you to engage in uncompetitive conduct unknowingly or sometimes knowingly, because it's a business and most businesses want to make profits, but knowing that the competition agencies are on your radar, so you don't want to increase compliance risk from the fines that competition agencies are likely to impose, or also your reputation in this regard. And that's why compliance becomes important. So some of the risk areas that you have to identify is pricing. How do you price your products? Do you share this information with other participants in the market so that you avoid engaging in price fixing? So as we said, this is a multi-sided market with so many participants that you are interacting with. So how you interact with these agent networks? Are you engaging in exclusive agreements, market allocation, rules relating to onboarding conditions for competition providers? Are you opening, if you are providing a critical infrastructure, what are your onboarding conditions? Access, interoperability. So if you're a fintech company and you rely so much on Android and you'd like your app to be interoperable with the Android, if Google refuses to give you that access, are you able to identify some of the objectives as justification that they provide? And if not, are you able to bring this to the attention of the competition agency? So these are some of the issues that you look into: access, pricing, data. Article 11 of the FCFTA competition protocol prohibits businesses, whether you're providing infrastructure or not, from combining personal data from different platforms. It also prohibits digital platform providing an intermediation platform from also using some of the data of the businesses that are operating on the platform, especially when that data is not public. Of course, the issue of bundling and tying, and then very important is deals and joint ventures that you really have to look into. So once you have all this, the next thing you have to look at is now how to design your compliance program. And one of the things that people forget in compliance program is evidence. So for example, if you're a member of FITSPA and you had discussions and some of the discussion involved competitive, sensitive business information, and you don't want to be part of it, so that when the technical committee is investigating, you'll be like, no, I wasn't part of it. You have to have evidence. And that's why in the first presentation I made, I said you have to indicate in the minutes that I was not part of this discussion and I did not agree with that. So for every engagement with your competitors, with other businesses in particular relationship, you must always keep records. Records relating to meeting minutes, refusals, incident files. Always make sure you kept that evidence. So we've identified the areas of risk: pricing, access, data, joint ventures, mergers and acquisition, and so on. So things that you're not supposed to do is to make unilateral decisions, especially on pricing and fees, and some of the evidence you really have to keep include pricing memos, data, and so on. And then when it comes to having this kind of interaction with other competitors or having these discussions within your trade association. Always keep your minutes and then keep your agenda. And very importantly, you have to have, as an organization, you also have to have a compliance officer, and you have to keep training. You have to keep training your staff on these issues so that they don't end up making public pronouncements on issues that may put your company at risk. So of course, the do's, just as I've said, if I was to represent businesses, always make sure when you are sending emails, chats on WhatsApp, okay, you're also taking into consideration the fact that you may be sending a message to your competitor that is likely to be anti-competitive in nature, or in fact that you would like to access information from the other side, and so on. So, of course, we talked about the do's. Always do a competition screen for every engagement that you're having. Don't share sensitive information with other participants in a trade association. Don't use exclusivity, time, refusals, discriminatory standards. And also, once the investigation starts, also make sure you cooperate with the competition agency. Those are some of those things. And anytime there's the red flags, always make sure you ask yourself, what next? So that is the end of my presentation on the do's and don'ts, but all of them still just apply to what we've discussed today. So in case you have any question, I think I've taken my 30 minutes, then Vera, you can tell us what next.
Doctor, there is a question for you in the Q&A section.
So the question is about advice on compliance program comes for digital players under this law. Of course, compliance programs will apply to all businesses because already Uganda has a competition law, and as long as you're participating in this market, whether it's the digital markets and the other traditional markets, you should have a compliance program to ensure that you don't find yourself violating competition law and having to deal with fines that the technical committee may impose on you, and therefore increasing the cost of doing business for you. So it's very advisable, and this is one thing that we try as much as possible, especially for trade associations, because in most cases, because of the secrecy that is usually involved in these agreements, most competition agencies find it easy to go after trade associations. And you can see in Kenya, when the competition agency was operationalized under the 2010 competition law, the first thing that the competition agency did was to have a soft mechanism and to bring on board trade association, because whatever they were doing then, sharing information, sometimes the trade association telling their members that you cannot charge products beyond this price in the form of resale price maintenance. For them, it was normal. It was so cultured. So the competition agency had to start now telling them, no, this is not allowed under competition law, and allow them to put in force, with the support of the competition authority of Kenya, compliance programs. And that is exactly what the Kenyan Competition Authority has been doing, even when in the digital financial sector. It has come up with the guidance notes to enable participants of digital financial services market to identify the do's and the don'ts. And also when to make use of leniency program. So leniency program is one of the tools that competition agencies use, whereby a business that was part of a cartel can come forward and report to the competition agency and say, you see what, in these markets, we did discuss this and this when we are having maybe a meeting under our trade association, and this is what happened, so that they get immunity from liability. So you have to be very, very, very careful, because you might think because you are members of a trade association, all of you are on the same platform, all of you are agreeing on issues, but of course, there's one of the businesses that is likely to report and make use of the leniency programs. So you really need to know this. You really need to put the compliance program in place. You need to define the do's, the don'ts. You have to train your members more frequently. And because, because of the technicalities, you know, when we talk about, let's say, like refusal to deal, it looks like, okay, you did refuse to grant access, but proving that is not very easy. So you have to train your staff on these issues and get relevant experts that can provide these advice based also on international practices. Yeah, so I'll share that that one. Let me just have a look. So and also just to make it okay. So also just to make an additional comment is that remember, you are not just complying with the Ugandan competition law, you are also complying with the COMESA competition regulation. You also have to comply with the FCFTA. So when drafting this compliance program, you also need experts that can help you navigate all these regimes. Yeah.
Thank you, Dr. Vela. That brings us to the end of our 5 modules, and we'll now move into the Q&A session. In case anyone has questions, feel free to type them in the Q&A section or raise your hand and you'll be unmuted to speak.
Yes, Blessing will share the presentations.
Okay, since there are no questions, I'm going to invite a managing partner of Diamond Advocates, Mr. Galandi Tony Chire, to close the training. Mr. Galandi, the floor is yours.
So is my video on?
No.
No.
Going as a panelist, yes. I guess so. Yeah, yes. Great. I think this is super. Thank you. Yeah. This is, I think I'm good. Yeah, thank you. Okay. Thank you very much, Dr. Vera, and everybody who has joined us. I hope my video is clear. First of all, good afternoon, distinguished speakers, partners, participants, and colleagues. My name is Galandi Tone Kire. I'm the founding and managing partner of Diamond Advocates. And as we come to the end of this session, I want to express my sincere gratitude to each of you for making today a success. I'm truly delighted that we have had such a rich and productive session. And for me, today's discussion on competition issues in digital finance services market is a daybreaker. You know, us looking at effective compliance for our fintechs, I think for me is very, very important. And I'm very grateful that the speakers have been insightful, practical, and forward-looking. They have examined critical topics ranging from data dominance, platform power to predatory practices, regulatory expectations, and strategies for fostering a genuine innovation while maintaining fair competition. Ladies and gentlemen, I want to extend my deepest appreciation to the outstanding speakers. Dr. Ryan Hawthorne of Acacia Economics, thank you. Dr. Anthea Powell of the Alliance for Financial Inclusion, thank you. And Dr. Vela Kedogo Kigwiru of Technical University of Munich. This wouldn't have been a success without your selfless support. And Mr. Mburu Raphael of Competition Authority of Kenya, thank you very, very much. And the participants, I beg that we give hands up to these people in this very, very monetized economy. It's not every day that you find people who decide to democratize knowledge and give it out to the benefit of people who are going to make money. We want to thank you, and thank you very, very much. Competition law is clearly a new area of practice, and I think that's why Uganda Law Society was very excited to join us because they feel that they needed to learn this from you. Thank you for sharing your expertise so generously. Your presentations have equipped all of us with deep knowledge and actionable tools that will strengthen compliance practices across Uganda's fintech sector. My special thanks go to our valued partners, Uganda Law Society, Financial Technology Service Providers Association, and our global partner, One Global. For me, this collaboration reflects the kind of unity and shared purpose we need to build a resilient digital ecosystem in Uganda. And to every participant, whether you joined us from Kampala or other parts of Uganda or internationally, wherever, thank you for your active engagement, thoughtful questions, and commitment to professional growth. Clearly, the insights shared today will undoubtedly contribute to better regulated, more competitive, and consumer-friendly fintech services in our country. And ladies and gentlemen, as we conclude this, I pray that we all commit to applying what we have learned. True compliance, from where I sit, is not merely about avoiding penalties. For me, it's about creating sustainable businesses that drive innovation, protect consumers, and most importantly, support Uganda's digital economy. At Diamond Advocates, we remain available to support you as you implement these learnings. We also look forward to future collaborations that advance legal tech, competition law, and fintech development in Uganda across the region. We are very, very positive and optimistic that our second annual Fintech training will be bigger and better. We also have the confidence that this team will remain part of us as we organize a bigger and better conference next year. And ladies and gentlemen, I want to thank you for really turning through, and I can't thank you enough. I just want to say once again, thank you for your participation, and thank you, and thank you. To the team down here, special thanks to Vera Nakatumba, special thanks to Priscilla Naiga. This team has done tremendous, tremendous work. Thanks to Theresa Among and our digital team that has made this possible to have a virtual online training. Thank you very much, everybody. May the good Lord bless you. Thank you. Over
Thank
to
you
you.
very much, Tony.
Okay.
I'm now going to hand over to my colleague, Priscilla, for a vote of thanks and to officially close. Priscilla, the floor is yours.
Thank you so much, Vera. Thank you so much, Mr. Galandi, our managing partner. I am very grateful to our distinguished trainers, Dr. Vela Kigwiru, Dr. Anthea Pawelo, Dr. Ryan Hawthorne, and Mr. Raphael Mburu. Thank you so much. I do not even have the words to appreciate the panelists that we have. And maybe I must mention that this training was organized in legal terms pro bono. These speakers offered themselves to democratize knowledge at a free cost. They took the time to prepare the training materials, to go through the preparatory meetings, and to be here with us throughout the day. It is truly an honor. Thank you so much for supporting this cause. And like the managing partner has mentioned, we intend to have a long-term relationship and have another conference next year. So I thank you so much for your time. I thank you so much for your knowledge. And we shall have this recording available for the people who have either missed the training or were not able to join for whatever reason. We shall have it up on our websites and social media and YouTube and X. I want to thank the participants who have sat through this training. It's very hard to have people's attention from 8 to 1 consistently. I want to thank you, participants. Thank you so much for sitting through this. Our biggest worry was sustaining you on this virtual training, but surprisingly, the number has remained consistent. Thank you so much. And we shall be sharing a policy brief after this training. And you can reach out to us if you have any further questions. We shall be able to provide a feedback form. Thank you so much. We have come to the end of the training.